rules about April 2nd and the 5th and the 6th and the 9th and the 10th and the 12th and so on. And the last ones I heard came out, I believe they were in early August. If you go to the SBA's webpage, they have lots of information on the PPPs, which of course gets to be confusing. So I'm gonna see if I can click into that with my share button here. Share, there we go. Did that pop up?
Yep.
All right. So this is on the SBA website. I just clicked on the part that says Payment Protection Program. Now, on their page, they do indicate down here at the bottom that it did close on August 8th. So that date is done. Now, Mary and I are still getting used to the Zoom type stuff. You get to see my cursor?
Yes.
All right. So here we are, August 8th. So sliding it down a little bit, we have other parts, too far. Information about the loan itself, broken down by state of who actually got it, not as big of a deal. We have borrower application form. We really don't care anymore because the deadline of getting the loan is gone. And we have frequently asked questions, which as you can see on the right-hand side was updated last on August 11th. Yeah, the ones I have that I printed out were May 3rd, so I know I'm a little behind on even keeping up on that. So if we go to the website and click on that frequently asked questions, we will find that they have, as of August 3rd, download a list of questions. Now I'm just going to drop down to the bottom and see how long this thing is. 2 pages, 3 pages, 4 pages, 5 pages. Okay, that's let's go to the bottom. 18 pages of questions, 51 of them mentioned. And when you get to the 51 questions, it's not quite that clear because in the beginning, they start talking generalities of the PPP. And then when they get down to each specific area, at least in the May edition, they would start over with question 1, and it doesn't look like they did that this time. Okay, so going back to the beginning of it. I would suggest that everybody print a copy of these questions. That way you have them and then go check often to see if they've been changed, because this date up on the top tells you the effective date of this print.
David, I'm going to try and drop the download of that into the chat screen so people can look at it.
All right, that sounds fine. Oh, gotta make it a little bigger on my side so I can see it. There we go.
Yep.
Okay, so we get down here, it talks about the lenders confirming the dollar amounts, and I don't care. It doesn't bother me a bit. So let's go down to the next one.
But when you ask forgiveness, there's a loan number, so you have to be careful of that.
Go ahead, dear.
On the loan application, we happen to have a gentleman come in our office yesterday that has the forgiveness, is looking for the forgiveness. And one of the things that was required for the forgiveness was an SBA loan number. So when they do have their paperwork that they get, that's one of the things that they're going to need. Beside that, there is also a bank loan number. So 2 of those things, when you're filling out the forgiveness, they're going to have to be provided by the client.
Call from name unavailable.
Say that again, Laura.
What's calls from?
Okay. So as we look through the questions, question 2 is just talking about, again, who can get it. And that's not important now because we're past that point. Question 3, does your business have to be qualified small concern? Again, they've already got the loans. So whether they qualify it again for it or not really doesn't matter unless Congress brings this back. And in case you haven't heard, Congress is still talking about whether or not to bring this kind of stuff back. And as you also know, Congress is half Democrats and half Republicans, basically, between the 2 House and Senate, and they don't know what they're going to do. Getting them to agree, as you know, is always a difficult issue. So the number 4 talks about the lenders. Number 5 talking about affiliation rules. 6, 7 talks about excluding. Somebody had a question about the compensation area, and that may be best covered here in number 7. excludes from the definition of payroll any employee comp in excess of annual salary of 100 grand. That means if you have any employee who is getting paid more than 100,000 in a year, you got to limit it to the 100,000. Fairly simple calculation. Divide the 100,000 by the 52 weeks in a year and prorate it for the number of weeks that you're using in your calculations. The exclusion this 100,000 limit applies to their cash compensation. As it says here in the answer, not to the non-cash compensation issues. So in addition to the 100,000 of payroll prorated, we do get to pick up employer contributions to retirement plans, to the health insurance, as well as any taxes that are assessed, which would be the matching FICA, the state unemployment, those kinds of items in addition to it. So we do get more than just 100 in compensation when we're looking at payroll costs. Question 8 asks if it includes a sick leave. As you may know, one of the coronavirus bills said that employers that have less than 500 people have to offer their employees sick leave if they're gone for certain reasons, such as business being shut down under state order or federal order. Well, that sick leave is also eligible for this year as well. So that can be part of your payroll compensation. We got to be a little careful because there is also a sick leave credit that they can get on their 941. And as it makes sense in most tax things, you can't do both. You can't have the sick leave used for the PPP forgiveness at the same time you get the credit on the 941. And that kind of makes sense because that'd be double dipping. You get it once when you get the PPP because it's money that you've received that's not taxable when it's forgiven. And if you get it again on the 941, the government's paying it out to you again. So it doesn't make sense that an employer would get paid twice for the same money that was used to provide sick leave to the employee. So we're either going to use it here or we're going to use it for the 941 credit, one or the other. And if you got enough sick leave that you can get both, that's fine. Use some of it here and some of it for the 941. It's a choice. Question number 9. If your small business is seasonal, you can still get it forgiven, but what they look at then is what your pay was in the prior year during that season time. And when I look at that, first thing, of course, that I think of is the tax profession, because we're definitely seasonal. There's a lot of us that'll make a lot of money in 3.5 months and the rest of the year not make as much. Mary and I have kind of evened that out to some extent by doing all these seminars. Last year we did, I think it's either 99 or 100 seminars around the country. This year we're doing less physical, less face-to-face. We're doing a few online like we are today, this kind of concept. So our business will be down naturally, but our business is still heavy and during the tax season. Third party, having somebody else do your payroll, that doesn't matter for question 10. That's fully acceptable. Question 11, do the banks have to have original signatures? The bank will tell you what they need, but copies are acceptable, although some banks may be more particular. Kind of like when these loans first came out, the banks were able to make the loans, but some of the banks said, we're not going to do it. We had at least one in the Green Bay area that refused to do it at all. Another one only did it for their own customers. That was actually quite common. And we had one bank that was approached by a tax professional because we do not have the right to get paid or charge our client to help them set up these PPP loans. And yet the bank can pay us. And the bank, one of the banks here in Green Bay said, if a tax professional puts together the work for the client and submits to us a request for payment for their time, we'll set their application on the side and ignore it. So the banks were basically saying that they're getting paid their 1%, their 3%, their 5%, and they didn't want to share it with us. And that was because they had so much demand for the loans that they didn't see a reason to share it with anybody because they could lend that money out to somebody else and still get the full amount and be able to keep it. So we did have some issues of that type here. Question number 12. Need to request a loan to support your business. Again, that's looking at it up front, and this involves whether somebody that has been guilty of a felony is able to get it. Again, that's all up front. Question 13, again, applying for it up front, using the government portals, that's fine, or the bank portals. Let's see what else we got here. I'm going to skip through these fairly quickly. Question 14 is the loan amount. Question 15, can a independent contractor or sole proprietor get these monies as far as payroll cost? 16, federal taxes. I'm going to try to get down to the forgiveness part if I can. I filed for it in April. 18, FinCEN rules, up too high. 19, promissory note. Meanwhile, Mary's looking at it too. Question number 20, the amount of forgiveness. Now here we have an 8-week or 24-week time frame. When the loans were first issued, there was an 8-week time frame for your spendability, so to speak, to get it forgiven. When the loans came out again and were renewed, there was a 24-week. So as you read the literature on the SBA websites and other places, there was the choice of you have the 8 if you got the loan before a certain date, you had 24 weeks if it was after a date. But when they came up with after the date, they said anybody that had the 8-week time frame could choose to use the 24-week. They didn't have to be stuck with the 8. That's a good and a bad. It's a good because they got more time to spend the money. It's a bad because of the limitation of how much you must spend on payroll. When you use the 24-week period, 60% or more had to be used for payroll. If you use the 8-week period, 75% or more had to use payroll. So when you just think of those numbers, it would make sense to use the 24 weeks with 60% used for payroll as a minimum because it's longer time and you don't have to have as much for payroll. But the way that it was worded, it looks like you must use 60% of the total loan amount and the total loan would be forgiven if you met the tests. Whereas the 75%, you had to use 75% of the amount you're requesting to be forgiven. For example, if you had a loan of 100,000 under the 75% rule, and you only had payroll of 50,000, you could still request abatement of whatever 50,000 is at 75%. That would come in about 65,000 roughly, and have 65,000 forgiven. But under the new rule, you had to spend at least 60,000 for payroll out of the 100 in order to get the full thing forgiven. And there was no opportunity to get a partial forgiveness. So the 75% allowed a partial forgiveness. And of the partial you're looking for, at least 75% had to be payroll. The 60% appears to be all or none. So that was a choice that we had a little bit of impact on the 8-week versus 24-week as they have in question number 20. Question 21, do you got to do anything with the SBA? And the answer is no, that's all taken care of by the bank. 22 is a bank lender. Let's continue down. Non-bank lender. 10 million, I don't see that being an issue. 23 or 24. 25. Again, I see that being on the lending side. Did you find forgiveness?
Not yet, no.
Okay. 26 approval, 27. I don't see that being helpful. 28 SBA. If anybody happens to find where the forgiveness are, just pop it up. We'll jump there. I think number 30 could be an interesting one. Can the bank sell your loan? And the answer is sure. They can sell your loan just like anybody else can. Now, that may be nice to know, but that also means that when you're requesting the forgiveness of the loan, you may be sending your application to somebody other than the company that lent it to you. One of the potential issues that could happen here is that the company that lent it to you looked at your records and said, yes, you qualify for this much loan based on our interpretation. And the company that's looking at it for the forgiveness may not agree. They may not feel that those expenses that were looked at to get the loan are also eligible expenses for the forgiveness. It's supposed to be nice and clean and easy to understand, and yet they keep changing the rules, keep changing what they tell us. So that could be an issue if they do sell it on secondary market, because that new bank is the one that's going to have to approve the forgiveness.
Question 40, loan forgiveness
Okay.
option.
Let's see, 32, 33, 34. 35, 36. Let's go on down to, I think it's number 40 is what Mary just said.
I think that's an interest.
Question 40. Will their forgiveness be reduced if the borrower laid off an employee, offered to rehire them, and they decline the offer? There is a provision that says if your payroll goes down or the number of employees you have working goes down, that you may not be able to get the full amount forgiven. And this question is saying, basically, I offered the employee their job back and they wouldn't take it. In that kind of a situation, the government takes that into account, or the banks take that into account to determine if there was indeed a decrease in employees, and basically will not penalize the taxpayer because the employees didn't come back to work. Now, we've had some situations where employees didn't come back, unrelated to the PPP loans, but they didn't come back to work because the unemployment they were getting, especially that extra 600, was a whole lot more than what they were making when they were working, or it was comparable and they didn't want to give it up because I can make all this money and not have to do anything. So some employees were not willing to come back and work for the employer again. It's not just a simple matter, though, of offering the job to the employees and they turn you down. You do need to do a little bit more work. I'm going to scroll down to the answer a little farther here. In the answer for number 40, it does say that the interim final rule, I love that phrase, interim final rule, that you borrower must make a written offer of rehire, not just verbal. The employee has to reject it. And then you also have to file a claim with the state unemployment office, letting them know that the employee rejected the offer to work, which means the employee is not going to be able to collect unemployment, quite possibly, which also means that employee is probably never going to come back and work for that employer again. And that's where we've had some issues with employers that have offered the employees work. They turn it down because, again, the unemployment benefits are so good. And the employer has not told the unemployment office that the employee turned down work. So that's it's not a legal question, really. It's more of an ethics question, morals, business decisions to look at. But the keys here that I've seen is it has to be in writing. The employee has to reject it, and the employee needs to know that they could end up forfeiting their unemployment account. Let's see, seasonal. Hospitals, they can get this thing. 43, 44, were there others in there?
Go to 45. It's
45?
a conjunction with the credit. Retention.
45. Is an employer that repays its loan eligible for the employee retention credit? The employee retention credit is something you get on the 941. Employee retention credit has been around for a few years now, involving federal declared disaster areas like the Hurricane Irma, Maria, Harvey, California wildfires. So they've been around about 3, maybe 4 years. This year, the employee retention credit is a little bit different related to the coronavirus. And we can talk about that separate if you guys want to. But the point here on number 45 is anybody who has the PPP is not able to get the employee retention credit, which again makes sense, because if you got the PPP loan and it gets forgiven, you're not going to be able to also get money back from the government for paying the employee's wages with money that wasn't taxable to start with. So they have the restriction that you can't have the retention credit. Question 45 is saying, if this is a loan and you have repaid the loan, then you're able to go ahead and get the retention credit. And the payback of the loan is based on the way the loan was set up. You can see the date in here, May 18th of 2020 is when they could pay that back. And I know there are some companies that did do that, especially some big ones that got public flack for taking the loan to start with. And I know some of the big ones did turn around, pay it back, and have reapplied and received loans again. I don't remember the names, but I do remember reading at least one big company that did that. Let's see, the PPP will look over the necessity for the loan. That's again, get in the loan.
I didn't see anything else on debt forgiveness in here.
Okay. Mary says she hasn't seen anything else on the debt forgiveness in this area. 47, 48, getting the application in. 49, the maturity date for the loan. Loans on or after June 5th. They got 5 years to repay it. Now, this is not the forgiveness, this is the loan itself. So if it does not get forgiven, they have 5 years. The loans before that had a 2-year maturity. Now, when they came out with the PPP Flexibility Act and gave us the 24 weeks and gave us the 5-year payment, they also said any of the old loans would have a 5-year maturity, but it's important that you get all of the story, and here's the rest. Highlighted on your screen, the borrower and lender both have to mutually agree to have the 5-year payback. If that does not exist, then the older loans have a 2-year payback, and only the newer ones would have the 5 years. So it's got to be something that the bank is willing to agree with as well. And if you think about it, the bank is lending this money a 1% interest rate. So with a 1% interest rate, could the bank force a payment within the 2 years and turn around and lend it at a higher rate? Probably. So why would the bank be willing to go to a 5-year repayment on this instead of a 2? Maybe it'll avoid foreclosure. Maybe it'll avoid the loan going bad. And I don't know all the rules behind it, connection with the bank with the SBA, but at a 1% loan, I don't know if the banks would be willing to extend this thing out 5 years if they don't have to. But every bank's going to make their own decision, and it may depend on the lender, the customer. And question 51, the last one, do the payments that do payments required for the provision of group health benefits?
Dental and vision, when you're using.
Oh, okay. I think the word including is probably include. Do payments required for the group health benefits include insurance premiums and vision and dental? Yeah, those are considered health insurance for that purpose. I think it's the last one on this page. Yes, it is. So if I back out of that page, back to the normal SBA page, which I think I can click that one. Okay, no, I can't. There we were. The SBA again has how to apply, other information, including the loan amounts, faith-based organizations, and then just some affiliation rules, which I don't think are going to be important to most of us. Below that is details about the loan. And again, the frequently asked questions. I think this is the same one we just were in. Let's take a look. Is that the same one you got there?
Yes, it looks like it.
Nope.
No?
This is a different one. In case you didn't see where I went, I'll go back into it. I was on the SBA website. And we had these items up here, and I went through the frequently asked questions up there. Here is the lenders and borrowers. Down below that a little farther is the questions about the forgiveness itself. Basic rules listed on this homepage: interest rate of the 1%, 2 years versus 5 years, no payments for 6 months, no collateral required, no personal guarantees required, and there's no fees involved. But if I click on the forgiveness, I will have a whole nother batch PDF, which again, you might want to put on that chat area. This one has questions on general forgiveness. Then we have questions on payroll costs, what's counted in that.
Excuse me a
And-
moment, David. Excuse
Yep.
me a moment. Bob, could you drop that file back in? I somehow can't, but could you do the one he's talking about now into the chat? Go ahead, David. Sorry about that.
Okay. Going on down to page 6 of this, we get loan forgiveness, non-payroll cost questions. And you can see they renumber at number 1 each time that they got a new header. Scrolling down further, we have reduction rules, and this is when you have less employees than you had before. And let's see, then we have the EIDLs. Some people receive these payments, these grants right away. And there's a connection between those and the PPP, basically saying you can't use the same numbers for both the same dollars. You have to be able to keep them separate. And I think that is it. So 11 pages on this one here. And that again was updated on August 11th, the same date as the others. So under this one, which gives more details specifically just on the forgiveness, the applications can be done by anybody. You don't have to have employees. Of course, you didn't have to have employees to get the loan. You don't have to have employees to be able to get it forgiven either. Scanned copies of documents are acceptable. They don't have to have them all in writing. The forgiveness itself, the application is on the SBA form 3508 or 3508 Easy. We have a choice of which form we want to use. Some lenders will have their own. Here it talks about in question 3, bringing that up, and again, I'm going to make this bigger. In question 3, if the borrower submits the timely application, do they have to make any payments? And the answer is, as long as they submitted it, they don't have to make any payments until the SBA comes back with their answer. Once it's forgiven, then they're not responsible for any payments. If only part is forgiven, they are responsible to repay the rest of it, and of course, the interest on the amount that's not forgiven. For payroll costs, question 1, we could take all payroll costs, and we're looking at the payroll costs during the covered period, or as it says, the alternative payroll covered period. We can use either one. The payroll covered period generally is going to be anything from the April 20 through October 4th. There we are, through October 4th. Payroll costs that are incurred, keyword incurred during that period, but not paid. What they're trying to say here is you may not have the payroll actually paid during the period, but it was for work performed during the period. So we can calculate it either way. Obviously, we can't double up. But if you got employees that are earning money during the period, then it gives you better results than those that were actually paid. That is acceptable. See if they give the answer further. No, here's an answer though. The payroll does have to be paid for that earnings the next payroll period. The example I think kind of glues that together. They got their loan in before June 5th. They're choosing to use the 24-week period. So the covered period runs from when this thing started through October 4th. They got a biweekly payroll. Their payroll cycle ends on the 18th. Borrower is not going to make payroll until the 24th. So since the payroll costs were not incurred during that time, but payroll costs were incurred in essence, I should say paid in essence, at the time they actually did their payroll, they are going to be able to count those for the loan forgiveness. So even though the work was done before the time frame, the fact that the work was paid during the time frame they can use, or earned during the time frame, either one, but we got to choose one or the other, and the payroll costs related to that same thing will work. So to put that in a little bit different words, if you pay the payroll during the time frame, you can use the payroll taxes and costs that were connected with it. If you're using the earnings that employees made during the time frame, then you use the payroll costs and related expenses also earned or incurred during that same time frame. So you can't use paid for one and incurred for another. Question 3 talks about the biweekly. Let's see. Trying to remember which of these questions that I wanted to go through. This example here, using a biweekly payroll cycle, 24-week is June 1st to November 15. The first day of their payroll cycle is June 7th. So they can use June 7th and then on November 21st. And they can use payroll cost incurred, earned during that time frame as long as they were paid on or before November 21st. So this is looking at the actual pay date is what we're looking at on this one. Again, we can use the incurred date instead of the pay date if that's easier or it does better results. So far, we've only worked with one repayment forgiveness here, and it didn't make a difference. We were easily over the payroll for the entire amount. So it didn't matter which method that we went with. Let's see, question 4. Should they use the gross amount? And the answer here is, yeah, the gross amount should be used. The gross amount that goes on employees before taxes, before benefits, before anything else. Now, this is the gross even before they do pre-tax items. So when we're looking at the other costs, like the health insurance, if the employee has part of their pay used for health insurance, we do not get to count that again as a payroll cost. If the employees put money into their 401k or retirement plan out of their paycheck, we don't get to use it again when we're looking at the other payroll costs. We do get to take into account what the employer's paying, but not the post-tax or pre-tax that the employee is paying. And if you're looking at things like the retention credit and the other credits on the Form 941, we do take into account pre-tax items for that. We don't take into account the fact that they're pre-tax here. We look at the gross paycheck the employee made. Let's see, 6 expenses for the group health, and I believe this covers it on the top of the next page. Yep. Employer expenses for the group health expenses that are used for this purpose. Payroll costs do not include expenses for group health paid by the employees on a pre-tax or post-tax basis. So again, whatever comes out of the employee's paycheck is not eligible for the forgiveness issue here. It's only the employer side. Number 7, contribution retirement plans. We're going to find the exact same thing, that you don't get to use the employee contributions. We only get to use the employer contributions. And here's where it talks about that in the center of 7. Cannot include anything deducted from the employee's paychecks. So it's just the employer side. Question 8 is a question that I've seen being asked quite a few times. Since we're going to 24 weeks, what amount do we use for the owner, for the owner's compensation? Under the 8 weeks, we had a limit of $15,385. Well, that was the limit under the 8 weeks. So when you go to 24 weeks, well, it sounds like it should be about 3 times that, or roughly 45,000, but that's not the way it's set up. It's set up as 2.5 months worth, which comes in at a cap of 20,833 for the owner employees and the self-employed people. So the IRS, or in this case, the SBA FAQ very clearly says it's 20,000 that we get to use and not the 15,385. In the case of a C Corp, they're saying basically the same thing. 2.5 months out of the 12, again, limit 20,833. I don't have a good reason why they only get 2.5 months out of 12 instead of 24 weeks. I don't have a good reason. I did not go into the Flexibility Act to see what they had to say. S Corps, same thing, 2.5 months out of 12 of their 19 compensation. Yeah, you can pipe up.
That's fine.
Okay. Another part that we might want to think about is the health insurance. We know the health insurance for the S Corp shareholders goes on the W-2. And what they're trying to say here is that the employer contributions for health insurance are not eligible for the forgiveness here. I really don't have a good reason why. It's just what they're telling us here, that we don't get to count that in the picture. And that, of course, includes all family members under attribution rules. Now, it does say anybody that owns at least 2% of the company. So if you have S Corp shareholders that own less than 2%, then the health insurance would be part of their compensation. The last statistics that I saw, I think it was 89% of S corporations are owned by 3 people or less. So we do got a lot of people that, or a lot of S Corps, I should say, they got very few owners. We're not going to have a whole lot that have less than 2%. Self-employed people, again, we're looking at their profit on their 2019 tax return. If they just started the business, we can look at what we anticipate their 2020 to be, but otherwise it's based on their 19 farm profit or their 2019 Schedule C profit. Again, 2.5 months. Now, this is not always a good thing in a way. And by that, I'm going to refer to what I heard my wife mentioning the other day involving President Trump. I'm sure everybody's heard that President Trump didn't pay any taxes and he paid $750 and all those kinds of things. I didn't see the tax returns. I don't know what's real, but it wouldn't surprise me. But think of what happens when a client with a business of their own walks into your office. What are you typically going to try to do? Is minimize their tax, get it as low as you can. That's what they want you to do. That's what they're asking you to do. So President Trump walks in my office and wants me to do his tax return. I'm generally going to try to get it as low as I possibly can. I'm going to take advantage of 179, take advantage of bonus, take advantage of whatever credits qualify. I want to do the best job that I can. And if I can get his tax down to zero, and that is what we want, then naturally I'm going to try to do that. The same thing applies here. A client walks in our office, they're self-employed. What do they typically want us to do? They want us to get their taxes as low as possible. So when they do that, and their 2019 tax was real low, not knowing what's going to happen for 2020, of course, they're limited on the forgiveness side of this, 2.5 months out of the 12, simple proration of what their 2019 profit was. So even if they're going to have a big profit in 2020, but they only had a little one in 2019 because we took bonus or 179 or whatever, they have limitations on how much they can actually get forgiven. So in hindsight, we have potentially hurt these people on their forgiveness amount because we have eliminated or reduced their profit last year by a large amount. Of course, that was before we even knew this thing existed. If you did the return in the early part of 2020. If you did it in April or May or June and were aware of this issue and that they had a PPP loan looking for forgiveness, maybe we would have done something different on that Schedule C or Schedule F. But if we did it in our normal routine of trying to minimize their tax, we may have hurt them in the opportunity to get some forgiveness. Same thing with the partners, sliding my screen up. Same thing with partners in a partnership. If we try to minimize that income, it may have affected them. And here in the partnership, you do see that the 2.5 months is taking box 14A, which is self-employment income from the partnership, and reducing it basically by items that reduce SE when it hits the 1040. The 179, the unreimbursed expenses, the depletion expense, and I think there's one more on the next page. Nope, that's the list of them. So since those are reducing the self-employment income, they're reducing the amount that's eligible for the forgiveness. LLCs, same thing. If they're taxed like a partnership or if they're taxed like a corporation, they follow the corporation rules. Non-payroll costs, we got the mortgage interest, not the principal, but just the interest, rent expense, utility costs. I really like the utility costs issue. Two reasons. One is the incurred versus paid. In the example, you can see that they have the period from April 20 to October 4. They get a bill on May 4th for the month of April. Well, most of April is not in that covered period, but they paid that bill on May 8th. That is an eligible expense for this. So it doesn't have to be just stuff incurred during this time. You look at the stuff paid, but again, you got to choose one or the other. Continue down to question 2. If they're incurred during the time but paid after the period, do they count? And if they're non-payroll costs, again, we can use the stuff that's incurred even if the billing is afterwards. But again, we have to choose. We can't use both. So we would not be able to use this bill up above that was paid on May 8th and the one that was incurred at the end of the period that hadn't been paid yet. So you got to choose one or the other. Let's see. On the utilities, they do give us a list. I'm looking for that here. That's loan interest. Here we are. On the utility payments, they have a list of gas, electric, water, that kind of stuff. They also have one that says transportation. And I've been wondering exactly what that was. And they've answered in the here. They say a service for the distribution of transportation refers to transportation utility fees assessed by the governments. That's what they mean when they're talking transportation. I was wondering if they're going to let me take the expenses of my vehicle driving around for my business. I kind of figured that was probably too good to be true. Here they're saying it includes these utility fees, transportation utility fees. Let's see, electricity, reductions on the amount. Now here we're talking about the employee who has, or the employer who has cut back on employees either cut back on the employees or not giving them as much pay as they were getting before. Now, again, it talks about the fact that they offer the job in writing. And here in the center of this question number 1 under this area, the borrower has to tell the state unemployment that the employee rejected their offer. And that usually means that the employee, of course, will lose their unemployment benefits. So we need to make sure we have the documents ready and willing and for this to be able to go through. Let's see, seasonal employer electing to use the 12-week from May to September. I'm not sure what that one's about there. Go down to question 3. When calculating the FTE reduction exceptions, do you take into account people that are making more than $100,000 during 2019? And yes, we do take that into account for the worksheet. The fact that people making over 100 grand, it does not make a difference on the worksheet. The worksheet is just there to determine if the number of employees that you have is being reduced. FTE, for those that are not familiar with the term, is full-time equivalent. We've used that with the Obamacare. Full-time equivalent would be taking all the hours everybody's working, not counting overtime, dividing it by 40, and you have the number of full-time equivalent people. That's question 4. Reduction that we're looking at here is kind of in the answer for question 4. If the pay is going down by more than 25%, then we would have a shrinkage in the amount of the debt that can be forgiven. I've not dug into that, so I don't have a lot of information on it. We can go down to the example number 1, which is kind of a lengthy one. They got their loan before June 5th. They're using the 8-week time frame. Full-time salaried employee pay was reduced from $52,000 to $36,400, and they did not restore it back up by the end of the year. The employee kept working full-time, so they're still a full-time equivalent employee. So when you go through the worksheet, you take a look at how much the salary went down, and dropping from 52 down to 36,400, it dropped by more than 25%. And they did not fix it up by the end of the year. So as you go through the steps on the worksheet, 39,000 is the smallest that they can be at to avoid getting penalized. They drop down to 36,400. So they have an excess reduction of $2,600. We entered that in the worksheet, and they will have a reduction of the amount that they can actually get forgiven because their payroll did go down. Continuing here, it says multiply the 2,600 by 8. And then divided by 52 to get the amount, we end up with a reduction of $400. So in this case, we're not looking at a large reduction, but we're still looking at some reduction of the amount that they can get forgiven. Let's see, down to question number 5. Purpose of calculating it, the reduction are all forms of compensation included, and you take into account the decreases in salaries and wages. So here we're looking at, as I read it, just the actual cash payment that's being given to the employee. By cash, I mean the gross wages. We're not looking at the other expenses that are related to, like the payroll taxes. That's the EIDLs. SBA is going to reduce that. Coming out, yeah, that's tied into the forgiveness. Again, you can't use the same amounts for both purposes. And that involves the change in the PPP loan. I think that's the end of that page. Yeah. So that's some information on the forgiveness of these things. And I'm going to stop sharing that screen, go back to just us. And I see you got some a bunch of things over there in the chat room. Are there things in that chat that would be tied to the PPP loans, Laura?
Most of the questions were in fact about where to find those, what you were talking about. So we put those in, and then in the very beginning, it's somebody wrote, discuss the taxability of stimulus that clients receive.
Okay, let's hold off on that just a bit and finish up a little more on the PPPs.
Okay. But other than that, that's it for now.
Okay.
If you go back to the PPP thing and scroll down, there is a section on certain non-payroll costs. that has some good examples in here.
Okay. Mary says, go back to the web. So I'm gonna pop back there,
Go back out of that.
out of this one. Okay, gotcha. So I'm gonna go back to my visual and back to my share. So I'm gonna take you back where we were. This one here. That was the frequently asked questions that we had just downloaded. I'm gonna back out of that.
Back further.
Back further.
Yep, to that main screen. Then go down.
So I'm gonna scroll up to the top of the screen so everybody can see where we were. This is the one that had the PPP link from SBA. And we had gone through the frequently asked questions on the loan program itself. Then we went through the frequently asked questions on the loan forgiveness.
Go all the way down to the forms.
If we go down farther, who can apply? Lender forms and guidance.
Go down to the bottom. The last item is.
Last
treatment.
item. Under this one here, lender forms and guidance on that same page. Treatment of owners and forgiveness of certain non-payroll costs down at the bottom. I'm gonna click on that link.
There's some interesting examples.
And Mary says, there's interesting examples on this page. This one here was published on August 27th.
So if you go down.
So I'm just gonna scroll down, comments, examples, owners, right here.
Yeah, there is some of the, if I went down into this part.
So in this area here, the Paycheck Protection Program, treatment of owners and forgiveness of certain non-payroll costs. So it's kind of defining what some of those non-payroll costs are. Owners, any individuals with an ownership stake in a borrower. Okay, we don't want to worry about those. We don't have anybody borrowing money that owns part of the banks. Eligibility of certain non-payroll costs.
Yep.
Is that what you're looking at, dear?
Yep, look at some of the examples.
Okay, our amounts. Question A up here on the top, are amounts attributable to the business operation of a tenant or subtenant in the context of a home-based business eligible. I'm going to expand this up bigger. That was number 2.
Yes.
Yeah. So if you're looking at a home-based business and a tenant or subtenant, the answer down here, I can't slide in there. The answer down there is saying that no, they cannot include any amounts that are related to a tenant or subtenant for a home-based business. Examples. Example number 1. Rents an office building, $10,000 a month, sublease is part of it. They only get the count that they keep. Totally logical. It's the only amount that's pertaining to their own business. Example 2, they got a mortgage on an office building that operates out, at least as part of it. Again, assuming they're renting out 25%, they only get to claim the mortgage interest on the remaining 75%. Again, that makes sense. Number 3, they share rented space with another business. They have to prorate that as well. Again, makes sense. Number 4 is the one that's working out of their home. When determining the amount of payroll costs that are eligible, the borrower may include only the share of covered expenses that were deductible. So here, if they're working out of their home, they would be able to take the utilities related to the office and home expenses, which of course is the business portion. Is that the way you read it too?
Mhm.
Okay.
But it's gonna go back to the office and home form.
But it's going to go back to the office and the home, which means the person has to have an eligible office and home and claim the deduction for those expenses. Rents paid to relatives, does that count? Yep. Okay, good.
That's it.
That's an easy one. And that's the extent of what they have here.
Yep, that's all. I
Okay.
saw.
So going back to the top of that page, business loan program. And I'm going to back up. That was the last link under lender forms and guidance.
Yeah.
So those examples can be useful because the more examples we see, the easier it is to understand.
Look at, there is requirement for loan forgiveness if that's of any use.
In the center here, there's one that says requirement for loan forgiveness. And we're kind of bouncing around here ourselves trying to see what's all here because we go in and out of it.
David?
Yep.
There are a couple of people have asked about rumors that below a certain threshold, the whole damn thing's going to be forgiven. What do you think?
Sure. Where's my 8 ball? It's around my desk here somewhere. I have an 8 ball on my desk that I pull up when clients ask me questions like that. And if you're familiar with an 8 ball, it always, you ask your question, you shake it up, and then you turn it over and look at the answer. And my 8 ball says, ask again later. So we don't know. There is discussion. The discussion I've heard is that if you have $150,000 or less loan, that it will automatically be forgiven if you just say, hey, I spent the money properly, and the bank says, okay, and it can be forgiven, which is a nice deal if you're at 150,000 or less. But that is a proposal. That means that the Democrats in charge of the House, or should I say the House controlled by Democrats, the Senate controlled by Republicans, would have to agree. Now, a problem with that is normal politics. A Democrat's not going to let a Republican have anything. A Republican's not going to let a Democrat have anything. So the odds of them getting together and coming up with something agreeable, I think, is actually kind of slim. But every once in a while, they surprise us. And I don't think it's so much that they have a problem approving that. It's the political system. I will agree with you to approve this if you give me that. And that's where we end up with 300, 500, 2,000 page documents, because there's so many little things involved in it and not just one simple matter. I think if Congress said, hey, let's only look at the PPP, let's see if this 150 forgiveness is reasonable, and only did that, I think we'd have an agreement fairly quickly. But that's not what happens. They're going to piggyback all of the kinds of things onto it, and that's where we're going to get people that won't vote for it. So will it happen? I think there's a decent chance. Will it happen before the election? I don't expect it. Will it happen in January in the new Congress? Oh, what a mess. How's that for an answer?
About as good as we can get these days.
I think so.
Thank
I
you.
think so. I didn't look at what this page here was. Temporary changes, loan forgiveness. Let's see, I'm just going to scan down through here, see if it has any examples or comments or requirements for loan forgiveness. A lot of regs that have already been issued. I love that word, interim final, again. General, payroll cost, interest expense, scrolling up. Utilities, including the transportation fees, non-payroll cost. Laura, every once in a while I get somebody popping up that's waiting to enter the room. I'm assuming you're clicking on those? Okay, good. Thank you. General process to get forgiveness. Now, on the forgiveness part, if you look on the right side where the right side of where my mouse is, you notice the lender has 60 days to issue the decision to the SBA on whether or not it should be forgiven. On the taxability of this, that timing could be important. So just kind of keep that in mind. I am going to come back to that. Payroll costs, again, what kind of costs are included? Example on biweekly payroll, I think that was also in FAQs. Employees that have been furloughed and getting bonus or hazard pay, whether that's counted or not, and the answer is yeah, those are counted. Ceilings, the 100,000 ceiling. And again, our 15,000 for the self-employed people, or the higher number if they're using the 24 weeks. When they're incurred or paid, I'm only about halfway through this document. Loans, reductions for payroll going down. Scrolling down to the header. Full-time equivalent employees, that can also be an impact. The gentleman we worked with yesterday had 3 part-timers, 1 full-time and 3 part-time. One of the part-timers got paid the entire time. The other 2 part-timers did not get paid. And when he got his PPP loan, he offered them work coming back, and both of them turned him down. So he did find another person to come in and fill the gap. So trying to keep the full-time equivalent comparable. There defines what the full-time equivalent is, which I gave you verbally a bit ago. Let's see, effect. Okay, so we talked about that a little bit. 25% decreases the max. So I guess looking at this document, and I'm going to go back up to the top of it, it again gives us more details, kind of like the FAQ does. And this one came out, if you look at the date on the right-hand side, the publication date was June 1st. The FAQs came out on August 17th, I think it was. So use this in combination with the FAQs to get into the answer. And again, this document was in the center of this segment under
The forms and guidance.
requirements for loan forgiveness. And at the bottom was treatment of owners and forgiveness. Are you suggesting go somewhere else?
No.
Okay,
Mhm.
continuing down that page, other guidance available. I'm not going to go through those areas. The forms themselves down here for the forgiveness, the easy and the regular. So when I look at this page, and I'm gonna go up to the top of it. SBA website, type in PPP or Paycheck Protection Program, you'll get right there. I got there just by going to the normal web. I Googled SBA, and right here's my Paycheck Protection Program, just by Googling SBA in my box up here. So it's not hard to find it. What you got to watch for when you do this is other things, like here's a Twitter account down here. And okay, that's SBA. Anytime I go to the web, and this is just general information, anytime I Google anything on the web or other search, I always look at the link it's taken me to. SBA could be a good one. SBA.com. What's the one up here? SBA.gov. Go away. SBA.gov. I'm not sure what SBA.com is. I'm not going to click on that one because that's not the government's website. I'll go down to these others. Fly SBA. Okay, that's apparently an airplane service out of Santa Barbara Airport. So I always look at those to see where I'm at. YouTube has been around a long time, probably safe, but I'd like to go to places that I know where they are. Okay, so back out of my,
The forms, do you want to talk about those at all?
do I want to talk about the forms?
I mean, just that they're there and the lender is probably going to send what they need to the person.
Mary says, let's look at the forms. So I'm going back to the SBA web page,
all the
way
way
at the bottom.
And show them that worksheet that was the difference.
Okay, I went down too far.
Yep, there.
Okay, let's just go down slowly. Kind of slowly. There's lender forms. So this should be the forgiveness application. Download. Blow that up a little bit. This is the form revised on June 16th. That's not the form you used before that. The form revised before that was back in April, I believe, but this is the new one. This is the regular form over here on the right-hand side. You can see the control number. That's the regular form. It does give the payroll cost adjustments if you have a reduction in pay or people, potential forgiveness amount. On this form, when you get down to line number 10, it says take your payroll cost from line 1 and divide it by 60%. And when we looked at that, we said, wait a minute, I'm looking at how much my forgiveness that I'm asking for to make sure it's 60%. Why is the form saying take my payroll cost and divide it by 60%? The reason is the form is saying take your payroll cost, divide it by 60%. This is the amount of loan that could be forgiven because you have met the 60% test. So it's a backwards of saying this is the maximum amount that could be forgiven. So don't let this equation fool you. Continue on through the rest of the form and just follow what it says. It will make some sense.
This one had a
The
worksheet.
top of the form is where Mary mentioned earlier. You have an SBA loan number, you got a lender loan number, and you got a PPP loan amount and the disbursement date. But this top one is where they're looking for two different sets of numbers, the SBA number and the lender's number. So you need to have both of those. The gentleman that we were working with yesterday did not have those numbers with him. So he's going to go back to the bank and get it from them because they obviously do have the numbers and they're the ones he's going to submit this form to. Scrolling down the regular form, a bunch of check boxes that they're saying that they've met these conditions. And they know if they screw up, they're in trouble. Again, the dollar amounts for self-employed people are in here in this fourth and fifth box. For your owners, I should say. Schedule A is a worksheet to again bring the compensation in and number of average employees to see if there is indeed a reduction.
Worksheet's not in there.
Should be one more worksheet behind it. The worksheet Schedule A, where you're bringing in the information from the employees to determine how much they do have. Limited to 100,000. Down here's the people that are over 100,000. What's in here?
That worksheet was not in the regular. in the
This
sheet.
worksheet was not in the package that Mary had yesterday, but this worksheet and the directions that go with it is all part of the regular form. I'm going to go to the top of that form. That's the regular form. So I'm going to get out of that regular form and go into, where was I? Stop sharing, go back out. There we go. Go back into sharing again. So I'm going back to the forgiveness application. That was the regular one we were at. The one immediately below it is the easy application. Opening that one up and downloading that one as well. Now this one up here on the top, you can see it's got the 3408 easy number. This one is shorter, I guess the way to put it. You got your loan number, you got your lender loan number. That information is pretty much the same. They don't have that payroll worksheet. They got your payroll cost and your interest and lease, utilities, those kinds of expenses. You got your same checklist. And it has some demographic information that they're looking for. And that's all that's on this form. So if you meet the conditions to be able to use the easy, it's a lot easier than, or a lot less to fill out than the other one where you got to look at your payroll. But one of the conditions to use this is that your payroll and your number of full-time equivalent employees has to stay the same. So you almost got to look at the long one first before you decide whether or not to use this one.
Or that worksheet's helpful.
Laura?
Okay, that's what I was asking. What I've been trying to follow along with you back and forth on screens, and the conditions are that your payroll must stay the same.
Yeah, let me back into that one. Let's see, close this one, back out of that one. Let's see, I believe it's in the directions for the first one. So I'm going to pop up the regular one. So I believe that's where they are.
Make your screen bigger.
Oh yeah, make it bigger so I can see it. Thank you, dear. Sometimes I realize I don't have to chew my screen to read it. I can just make things bigger. Okay, that's the instructions. Payroll period. Directions on the lines. Eligible costs. Let's see, instructions for the worksheet A. Okay, nothing there that's useful. So let's go back to the easy directions. That'd be weird. Of course, it makes sense. That could be where they're at. Yeah, there it is right on top. You can apply for it using this easy if you can check at least one of these three boxes. The borrower is self-employed, has no employees, and did not include any employees when they did the application to get the loan. Or the borrower did not reduce annual salary on any employee by more than 25% when you look at the period compared to the base. And they did not reduce the number of employees. Or we go down to number 3, they didn't reduce salary by more than 25%, and they were unable to operate during the recovery period at the same activity before because of requirements put out by the CDC and all these other groups. So if we can meet any of these 3, and this is in the directions on that 3508 easy, then they can use the easy. I still like the idea of the 150,000. Wham, you're done, not have to worry about it. Of course, government can make even that complex. And that doesn't exist currently. We got some banks in the area that are telling our customers don't apply for forgiveness yet because we don't know. We're going to wait till that thing comes out. And yet some of the people are saying, wait a minute, we got 60 days. So I'm going to stop sharing that screen and go back to just us. Let's go to the tax side of this thing. The PPP loan is a loan. They owe 2%. I mean, a 1% interest rate on it. They got 2 years to pay it back, maybe 5. It's a loan. Now, tax-wise, the Congress has said if this loan is forgiven, it's not taxable. That's great. Congress said it. That's the way it is. That means we're not going to pick it up as income. So on our corporation returns and partnerships, it's going to be an M1 adjustment, income that's on the books, but it's not on the tax return because non-taxable. IRS came out and said the way the Internal Revenue Code is written, if you're getting this money non-taxable, you do not get to write off the expenses, which in essence also almost makes it a taxable situation. So we go from not taxable income to no longer able to write off the expenses. Now, there's people not happy with that. Pelosi was one of those. And there was a senator as well that jumped up and down about it. And they're basically throwing a tantrum saying, hey, that's not what we intended. We want this to be totally tax-free money, and they still get to write off their expenses. IRS said, that's fine, that's what you intended, but that's not what you said. You said it's not taxable income. And the way the code is written, they don't get to write off the expenses. So the IRS told Congress, change the rules. You want them to write off the expenses? Pass a law that says that they can write off the expenses paid with this PPP forgiveness amount. So currently, we don't have the right to write off the expenses of the forgiven amount. Now, I'm going to go just a bit more into that. Right now, it's a loan. It's not forgiven until it is forgiven. The bank has 60 days to pass their forgiveness recommendation on to SBA. If you apply for forgiveness today, October 6th, that means it's reasonable that you might get the forgiveness notice by the end of the year, because 60 days from now would be early December. But what do you do if it does get forgiven? Let's just assume it does. How do you show it on a tax return? Well, nobody had an answer? Come on. I don't either. I have a suggestion. My suggestion is to show all the expenses on the tax return as normal. Your payroll on the return so it matches the 941s. Your independent contractors on the return so they match the 1099s. Your rent on the return so it matches the 1099 that you're issuing to the landlord. I suggest that we show everything on the return as normal and then do a negative expense. PPP loan forgiveness, negative 100 grand, 20 grand, whatever the amount is. So we have all of the expenses together and then a big negative to offset it, which will result in the net expense that we're allowed to have. I don't want to go through and reduce the payroll and reduce the rent and reduce the utilities. I'd like to have all those expenses be similar ratios to the income that they have been in past years. I know this year the income is going to be different just because of COVID, but the idea is we want those consistency. So I like the idea of just doing a negative expense. Is that what the IRS has said? Haven't found anything yet. Is that what other speakers are saying? Some are saying yes, and some are saying you got to reduce the individual expenses. So right now, my answer is I don't have an answer. I like my suggestion. Right now, I plan to do my suggestion. I guess if there's an answer out there, it's happened in the past because other people have received grants and not able to write off the expense the grant was used to pay. How did we do it in the past? Because this has happened many times before, just not on the broad scale that it's happening this time by affecting so many people. But I think that's a reasonable way to do it, because when I look at my payroll, if it's 23% in the past of gross receipts, I would expect my payroll to be around 23% of gross receipts again, and reducing the payroll because of the forgiveness would drop it down to 18%, which is an audit flag. So I like the idea of doing it as negative expense. A second part of the forgiveness I want to talk about, we've already had questions from different people, and it involves fiscal year entities. Basically, my year ends on September 30. I've applied for forgiveness in October. As of the last day of my year, was the loan forgiven? If it's not been forgiven, I don't see where we have any special thing to do. We have a loan that has not been forgiven. It's still a loan. It's on our books as a loan. We're going to write off the expenses as normal because nothing has been forgiven yet. And then in the next tax year, the loan gets forgiven. That's the year we got the tax-free income. And that's the year that I'll be making the adjustment on my expenses to reduce them by the amount that was forgiven. But in the first year, if it hasn't been forgiven by year end, I believe we still have the right to take expenses off as normal and not worry about special rules on how to treat the forgiveness because it wasn't forgiven. Anybody got any thoughts on that? I'd love to hear them or read them.
Yeah, put them in the chat if you have them. And in the meantime, we have a question. How do you define the difference between a self-employed taxpayer versus a sole proprietor?
Self-employed taxpayer and sole proprietor for tax purposes is pretty much the same. They are the same thing. They're just different words we use at different times. If there is a distinction between the two, I would say a sole proprietor is a Schedule C or a Schedule F. And a self-employed person could be a Schedule C, a Schedule F, or a partner in a partnership. So that's the only difference that I would see on those.
Talk about the loan, the IRS coming up saying don't do 1099.
Oh, the IRS on the PPP did came out about 2 weeks ago. And they told the lenders that are lending this money on the PPPs and subsequently forgiving it, not to do a 1099 on the forgiveness. So they told them not to issue a 1099-C. Of course, we still have to ask our clients, did you get a PPP loan? Was the loan forgiven? We still got to ask the questions so we can try to deal with it, but the lender does not have to do the 1099-P. C. Some people have read that and said, oh, right there it says it's not taxable and you can write the expenses off. No, it's just telling the lenders they don't have to do a 1099-C. That's all it's saying.
And then just to reiterate, at this moment, we are saying that the loan income, we can't write off those expenses at the moment unless they change something.
We can't write off the expenses on the amount that was forgiven.
Right. That's
Currently.
what I'm trying to say.
Right.
Okay,
Right. We
thank
cannot
you.
do that unless Congress changes the rules.
Excellent. I just wanted to clarify
And
that.
what you said, I'm going to pick on the words you said. You said we can't write off the expenses that we paid with the loan. And that's the improper wording. We
Okay.
can't write off the expenses that were forgiven of money that we got tax-free because it was forgiven. And that's where we may have a timing issue. Because if people are still waiting to apply for the forgiveness, they may not get that till after the end of the calendar year. And most of our clients are calendar year people. So we may have a year of deductions this year and next year lose the deductions, which could be bad because this year we're going to have less income very easily due to COVID. And next year our income is going to go up and we're not going to be able to have the expenses. So yeah, tax brackets can make a difference too. So maybe I would want to apply for forgiveness now before this 150th thing comes out, just to make sure that I have a reduction of the expenses in a lower gross income year. Assuming my income is going to be lower this year than next year, of course. And tax brackets might go up next year, who knows? Is that enough of the PPP for now?
Has anyone got any more questions about PPP? You want to put in the chat or raise your hand?
We'll do the stimulus question next. She mentioned that it's at the top of the thing.
And then how long does a business have to actually apply for forgiveness once their 8 or 24-week period ends?
Ooh,
Is that a 60?
I know that answer is here. I know the bank's got the 60 days. I'm thinking they got 6 months. Is that?
That makes sense.
Mary thinks it's also 6 months that they have to apply to get the forgiveness. I'm not positive, so I'll have to look through our papers and see if we can find something on that part of it. So I don't know for sure. I did see a question that you sent to me yesterday, Laura. On the 100,000 limit, I believe is what this was looking for. Yeah, for the 100,000 limit, if you got husband and wife both as employees of the S Corp, is it 100 combined or 100 for each? And as I read all the literature, it's each employee is on their own. So each husband and the wife would both have 100,000. for purposes of this forgiveness, which is of course that 2.5 month number. So you do not combine them together as one for purposes of the PPP loan forgiveness. That's one you sent me yesterday.
Okay.
And we're kind of looking for that time frame. It may be
Okay.
back on that SBA website page. Let's see if I can go back to that page and find it. I realize that you guys are not seeing where I'm at, but I'm just going back to that page to look at.
We've dropped all the links to where David has been on his screen. So you can have a look if you click on any of those links. We've also uploaded or downloaded all or dropped in the forms that we were able to PDFs of various things that David was looking at too. Those are all found in the chat screen.
Let's see. Oh, I think I might have just seen it. Who can apply? Oh, it's applying for the loans. I don't want that.
Maybe under that debt forgiveness thing that we saw at the bottom that you went through quickly.
They can be deferred for up to 6 months on the payments. Every once in a while, as Laura said, we will get calls from other tax professionals with questions. And just a warning that if you do call us, that's fine. Be glad to assist you. Don't be surprised when you get a bill in the mail because we do bill for our time. And sometimes when I get a call from somebody and I'm talking with them, my fingers are clicking away on my screen like they are right now. And you got no idea what's going on because you just see that my eyes are looking at my screen and you got no idea. And I still don't know. Okay, so I'm gonna go back to the chat and back to you guys. So I don't know what the time frame is on that. I think it's 6 months. We'll see if we can find out before we wrap up today.
I'm having a look too. There's so much information in various places. It's very hard to find. I don't know how you keep track of it all.
Yeah, it just keep checking often because they keep changing. I see a question somebody put up there. Can we put the client on extension if it doesn't get forgiven before April? You can always put a return on extension, but if you're cash basis taxpayer or even accrual basis, what was the status on the last day of your year? So if it's not forgiven as of December 31st, I don't think we have a right to say, oh, they forgive it next March and we're going to call it forgiven this year. I don't think we have that right.
Somebody also just asked, is PPP loan forgiveness denial appealable?
I believe the answer to that is yes. I believe you can appeal it. Yeah, it sounded like I was going to say more there, but I didn't.
I don't see anything in here.
Okay.
All right. Shall
So
we?
let's, yeah, let's go to other stuff if we're done with the PPP for the moment.
Yeah. Are you okay? Do you need a break? Does anyone need a break? What? I mean, the others can't answer because we've muted everybody. Because, but how are you doing,
Okay.
David? You
If
want to
anybody
jump right
feels
in?
that they need a 10-minute break, nod your head because I can see some heads. There's some heads nodding. Okay, let's take a 10-minute break and come back.
So we'll see you at 10:35.
10:35, sounds good. Thank you. And we're still visible. I'll keep my camera on just for the fun of it. You want me to do a timer?
I did it here. Yeah, you can, but
Okay.
I'll be a little off.
Let's see if I can find that PPP. Period. Now, see, they're not.
You kind of went through these questions, so it's probably not. Go into Google and type in.
Oh, there you go. That's a good idea.
Go into an extra box.
Yep. Deadline, keep them mate. No deadline according to this. Of course, that's Forbes.
That's a deadline for applying to apply. Oh, for the loan forgiveness. Okay.
That's Forbes website, and I got issues with their website. They put stuff out there that ain't totally correct.
But you
Okay.
can say what you found.
Now, this is the application itself. Now, are you seeing what I'm doing here? They're not seeing this.
Yeah.
What if I go back to the picture? Down here, I click on share screen.
Mhm.
And it's going to say, what do you want to share?
Yeah.
And that's what they get to see. So here's where they are. If I click down here, then they would see wherever it was on the web.
Okay.
So right now they're seeing all this.
And they see us in our
Yep.
little box.
And you're small because you're in the back.
That's okay. I'm fine.
Okay, I don't see anything on here for the timing.
No need to rush.
Journal accountancy says there's no deadline. You just got to start making payments.
Okay. Well, I think you.
Oh, wait a minute. There's not a deadline to have this application submitted other than 10 months after the end of the covered period. So they're saying 10 months from the end of the period. Period runs through
The 24th of,
the 24 weeks.
and well, the 24 weeks would be from the August 8th deadline, would be the latest one. Maximum.
That's the end of the period. August was the last day you could apply for one.
Okay, so then you take 24 weeks for that and then 10 months. Now, isn't there something about the end of the year?
Let's try this. Let's see what that does. SBA site. That's the form again.
Okay. I'm looking at the shortened application.
Mm-hmm.
Let's see.
What a good time.
Um,
There's an hour and a half roughly.
Notice some names that don't have pictures. Why? Look at Chuck Stackler.
He's the coordinator. Chuck was there.
Yeah, but no picture.
This
Yeah. Uh-huh.
one.
Yeah.
Needs pencil, maybe.
What's the lady sitting there?
This one.
There, yeah. She looks familiar. Okay.
Yeah, there's a lot more than was visible. It's 53 people on.
Mm-hmm. If you made it smaller, maybe you could
Yeah.
see more.
And it'd be harder to see anything.
Right, like they had for Georgia. What was up?
The first day of the covered period got the PPP loan disbursement date.
I don't find an exact answer.
Oh, maybe in the directions. Three minutes. 3 minutes left according to your clock.
And mine didn't start right away, so they may be even back sooner.
So far, David, I think it's going well. It's our first time doing something like this on Zoom. So we've done some meetings with the head of Department of Revenue, and we did a meeting the other day where they shared their screen, but it was going well. So I'm hoping everybody is giving us a thumbs up and finding it useful.
Okay, good, good. I put my camera on the top of my screen. I'm trying to look at it as opposed to any of the individual pictures. I've seen many people that put the camera down on the keyboard.
Oh,
and you get to count the nose hairs.
yes. I'm definitely thinner with it up top.
Hey, there Bill laughed, I think. At least Anita laughed over there. I can see you guys. See a lot, like I said, I see a lot of names and people that I've seen at seminars in the past. So it's always good to see people, even if it's not quite as same as visual or physically there.
Well, I'm delighted. We have 53 people on the call at the moment, and we've had a few people drop in and out, which we said, please feel free to do at the time, because it's quite easy. And I think so far it's going well. At some point, I mean, we can unmute people or at the end maybe for final questions, if that works. It's just hard with some feedback on people, but we can give it a try maybe toward the end.
Yeah, we can give that a whirl, see how it goes, because sometimes people would rather word it out and verbally say it as opposed to try to type something in.
Yep.
We did have a group in Wisconsin 2 weeks ago. They said, we don't know what we're going to get. 550, we don't know. And they just said, let's just do the program. And they ended up with 60 people at the program.
Oh, wow.
2 or 3 years ago, I think we had 125. So, you know, it's less, but it was still okay. It's been very interesting to see how they go and what all gets done. And we just don't know. We're all hoping that when the virus protection comes out, that it all works perfectly the way it's supposed to.
So we can hope so. Well, while we're all coming back on, I'd just like to bring up the date of December 14th for all our members. It's going to be a virtual, yet again, annual meeting. And we have Catherine Keene is going to give us a New York State update. And the head of the Department of Revenue, the commissioner, and his communications director will be on to give us a Connecticut update. And then we hopefully will have something else in the works for you all as well. So save the date of December 14th, and we'll put more information out to you guys for that. And with that, I guess, David, this brings us to the question and answer time. So how do you want to do that? Do you want to start with the questions we sent you, or how do you want to work this?
Well, you had one question that you mentioned before involving the stimulus money. So let's deal with the stimulus money and then go from there. Because you did send a bunch of questions and we'll get into those as well. The question, I believe, was something about what's the tax impact of that stimulus money?
Yes, it was.
Okay. So let's take care of the easy part first. It's not taxable. For federal anyway, it's not taxable. The money they get is just government money. Nobody has to pay tax on it. You do not have to pay it back unless you got it improperly. Improperly would be a dead person. We'll talk about dead people a little bit special in just a bit. But improperly would be somebody that is maybe a college student that's eligible to be claimed by somebody else because they're not supposed to get the money. And therefore, if they got the money, they should be sending it back to the government. On the IRS website, there is a address of where to do that too. And you put a note with it saying that they got it improperly. So other than improperly receiving it, it really is not income in any way. However, when we file the 2020 tax return, we need to account for it. The way the law was set up, just like back in 2008 and in 2001, when we had this before with President Bush and President Obama, the stimulus is a credit allowed on the 2020 tax return. And when you calculate the credit based on the 2020 situation, you reduce the credit by what they already got. So on the 2020 return, a single person's refund would be $1,200 higher than normal because of the law change. But since they already got the $1,200 this summer, their refund on the 2020 return is going to be what it normally is. So we're basically going to say, how much credit would you have got based on 2020? How much did you already get? And most people's answer is going to be zero. There's going to be no difference. They've already received the money. In their eyes, psychologically, they're going to say, so I didn't really get a benefit anyway, because you just told me I don't get anything on my 20 return. So they just gave me part of my 20 refund ahead of time. Well, in a way they did, but it is $1,200 extra money that you got up front, and you're allowed to keep it. So you are indeed getting that $1,200. So you got to be careful how you explain it to clients. For us tax professionals, we calculate the credit, we subtract what they already got. If they're entitled to more when we file the 2020 return, they will get the extra as a credit on the 2020 return. And it is refundable if they're just like ESC, it's all refundable. If the 2020 return comes up with a smaller credit because their income is higher, for example, tough. That's it. The government loses. Taxpayer got more during the summer than they really should have got as of filing the 20 return, and that's just the way it is. The government's not going to be asking for anything back. So we do need to know how much they got just to see if they got extra amount. I mean, if they're entitled to extra. The people entitled to extra would be those that did not get the maximum in the summer because of income level limits, and their income went down. They will probably get extra. Those that have a child that they're claiming under age 17 that was not there on the old return, they will get some extra because of that extra child.
Someone who has not received it at all.
Yeah, somebody didn't get it at all because their income was too high, or they didn't file an 18 or 19 return to get Social Security or any of those kinds of things, so they didn't get any money. They would be entitled to when they file their 2020 return. Somebody that maybe doesn't have to file the return but didn't have any of those benefits, the government said, okay, we're going to give you this date to file a, I'll call it fake return. It's an economic stimulus return. I don't know the letters, I forget it. Anyway, you can file a return saying I don't have to file a return, but I just want my money. They gave them a deadline. Then they extended it. Yesterday they extended it again, so now sometime in November. If they don't file a return, we can file a return for them and then get the money from the 2020 return. So it's not taxable. We just need to know how much it is to be able to get into it to determine if they're entitled to more. Back in 2008, there was a link in our software that took us right to the IRS website. You could put in the client's information and they will tell us how much the client received. I'm assuming or hoping we'll have the same thing again. And if it goes from our software, hopefully it'll take the client's Social Security number right from the software to the IRS website and probably, I don't know, information about their 18 return or 19 return or what it's going to send so we can get the number right away without having to think hard. That's the way it was back in 2008. So I'm hoping we'll have the same thing.
I was going to say, do you think our taxpayers or our clients really know what they got? And will be able to tell us.
They know what they got, and it's already October, so they've already forgotten. But if we look at the tax return that we filed for 2019, and the taxpayer's income is $60,000 for a single person, we know they got the $1,200. I would assume they got the $1,200 because we filed the return, and that's what they would have got based on that return. So as I'm doing returns forward, I plan to say, hey, based on last year's return, you should have got the $1,200. I'm assuming you got it, unless we got that link and we can check it out. Some people don't know. I had a client in here yesterday, we did their 2019 return. And I referred to, did you get the $2,400? No, we left that in towards next year. Well, last year's tax return had a $2,903 refund or overpayment that they credited towards the next year, and they thought that's what I was talking about. When I clarified that I'm talking about the stimulus payment, they did remember getting it. So they still remember now in October that they got it, but by tax time, yeah, a lot of them will forget. So it'd be real good if the IRS has that link to make it easier to file tax returns and know how much they actually got. I did mention dead people should not get the money. There was a argument about that, and maybe there still is. If you read the law on the stimulus payment, it says it is not to be paid to, and they have a list of entities or people that aren't entitled to it. And one of those on the list is estates and trusts are not entitled to the economic payment. Think about it. A person dies and a estate is created, decedent's estate. Who's entitled to anything that the deceased was entitled to? And the answer is the estate. So the decedent's estate takes over everything that the decedent had, all the assets, all the debts, everything that doesn't have the good old POA and TOA. Well, you can't do a POA or TOA on a tax refund. So this stimulus money would have had to go to the decedent's estate because the deceased is dead. And the law says estates cannot get it. So according to the way the law is written, as I read it anyway, a decedent's estate should never get the money, and therefore it should not be going to the surviving spouse or anybody else. It needs to go to the estate, and the estate can't have it, so they need to pay it back. The IRS has interpreted this to say, if the person died before the check was cut, then whoever gets the check needs to send the check back. Or if it's direct deposit, they need to write a check to the government to a special place and explain what happened. So as I read it, dead people should not get it. So put them on life support until the check is issued, then you're okay. Even though it's coming to, in essence, them, but they're already dead by that time. So that's the way I read it. It's not taxable to the Fed. I don't know about the state. And some people got it, shouldn't have got it.
I think it's going to be interesting this year to see if some of the people who didn't get it because they were just over the line, especially if they're retired people and don't have to take their RMDs, if they are going to purposely know that number and make their income such that they qualified for it this time.
So when we do the 2020 tax returns for anybody that didn't get the full amount, we might want a 179 or bonus things that we normally don't, especially if you got a state that doesn't match the Fed. Maybe at the end of the year, we want to send our bills out in early December so we get paid by the end of the year. No, wait a minute. Get our bills paid by the end of the year, but have our income deferred till next year like normal. And what's going to happen with tax rates next year? They're going to go up for 2021. If it does, deferring the income may cause us to pay higher tax, even though we can get more stimulus money this year because we didn't get it all up front. And we always got to play with it and try to figure out which way is the best to go. Other things on the stimulus?
I can't think of anything.
Some people will play legal games with the stimulus and some will do illegal. I'd prefer to focus on the legal ones. And it's not necessarily a game, but it's what may happen or they may cause to happen. So I'm going to take a situation with father and mother not married, which means either never married or divorced, doesn't matter, but they're not married. They're each filing their own tax returns. There are 2 kids. This year, the father claimed the kids on 2019 return. And let's assume the kids are under 17, keep this simple. So the father would have got the 1,200 plus the 500 plus the 500 for the other kid, a total of 2,200. The mother got 1,200, but she claimed no kids. On the 2020 return, mother claims the kids because they flip every other year. IRS is going to say, okay, you're entitled to 1,200 plus 500 plus 500, total of 22. You already got 1,200. Mother, you get an extra 1,000 on your tax return. Father files his return, just claiming himself. The worksheet says, okay, you're entitled to 1,200. You've already got 2,200 because you had 2 kids last time. So that means you got 1,000 too much. You don't got to pay it back. Now, in that scenario, the father got for both kids on the 2019, which means he got it during the summer. The mother's going to get both kids on the 2020 return, and it's totally legit. I'm going to change my scenario. And we'll have the kids be one son and one daughter. So the father claimed the daughter, the mother claimed the son on their 19 returns. So the mother got 1,200 plus 5, the father got 1,200 plus 5. So he claimed the son, the mother claimed the daughter. On the 2020 returns, they flip. He claims the daughter and the mother claims the son. The IRS don't care. The IRS says, father, you're entitled to your 1,200 plus the 500 for a qualifying child. So you're entitled to 1,700. You already got 1,700, you get no more. Mother, you're entitled to a 1,200 plus 500 for the son, that's 1,700. You already got 1,700 up front, so you're not entitled anymore. The IRS doesn't care that the son or daughter moved from one person to another. They're looking at the total dollars you got in advance compared to the total dollars you're allowed on the tax return. So again, where the father claimed one and the mother claimed the other and they flipped the kids, there's gonna be no difference. But where the father claimed both kids and the mother none, and the next tax year they do the opposite, mother's gonna get the money again. That's the exact same way it worked in 2001. That's the exact same way it worked in 2008. So they can play the system as long as it's legal and get double payment for the kids. The law also says you only get that credit if you're not eligible to be claimed as a dependent by somebody else. Not eligible to be claimed. And that's what usually is going to wipe out our college kids from getting this credit, this extra $500 or $1,200, because if their parents are eligible to claim them, that student is not eligible for the 1,200. A lot of them have already applied for it and got it. Some of them will apply for it on the 20 returns and get it, but it's eligible to be claimed, not whether or not they were actually claimed. Anything else you want to add on that, dear?
There were some people last year, because of the timing of when the credit came out, that held off filing their 19 return because they wanted it based on that, on the earlier return, and wouldn't have gotten it otherwise. So, you know, the timing of it might have caused some people to get stimulus payments that they wouldn't have otherwise be entitled to. But again, it's the way they base the credit on. So it's not anything that we have to worry about them getting something that they shouldn't have.
Now, there's a question in the chat, and forgive me if you just answered this. I had to go to stop a dog from barking. Says we've had several children receiving Social Security benefits due to death of a parent, and they received the $1,200. Do you think the Social Security Administration will take the money back automatically, or should we have the parent send back the stimulus check?
Ethically, it should be sent back, because that's, the IRS has said if you got the money and you shouldn't have gotten it, it should send back. That's an ethics thing. The real question, you know, the real question in your client's mind is going to be, how are they going to come after me? And honestly, we don't know. If it is based on the way that other payments have been asked back or secured back in the past, they don't have the manpower to do it.
So I'd be very surprised if the government went after anybody. I'd be very surprised if Social Security took it back out of their account. So I agree with Mary on all those. I also agree that they shouldn't have got the money and they should send it back. So if I had somebody that got that, that would be the advice that I would be giving them. I'm going to go to the IRS site. And yes, I'm going to go to my share now. The site I'm on now is irs.gov. I'm assuming everybody's been here. They've revamped it again. And will some more times yet, forever probably. When I go to the irs.gov website, the first box up here in the top left is get my economic impact payment. If we click on that, they have all kinds of information available, including a bunch of frequently asked questions. So clicking on get my payment, I'm going to scroll down to the frequently asked questions, which is right below the get my payment box. And of course, tomorrow they're going to change this whole website, or maybe this afternoon, or maybe next year. We don't know. But clicking on my frequently asked questions, we have a list of topics down here on the bottom of the page. If you look at the entire list, I think there are 91 questions last I checked. In the box up here, it does say use November non-filers. They got until November 21st to register and still get the money. If they don't, we're going to end up filing 2020 returns just so they can get it. But I want to go down to the questions and let's see, error messages, lockouts, payment status.
There's one about the decedent. Is that the one?
Yeah, where's the dead people?
It's in there. It's not. I don't know where it is.
Okay, so let's just
Payments issued but lost or destroyed.
payment status, payment issued, lost or destroyed. They had all these in one big package. Now it looks like they got to go to each individual one. Okay. I don't care about that one. File and joint, not recorded file return. Skip that one. Payment status, not those. Missing payments, not those. Issued, lost, or stolen. No. Why am I getting it? Let's see. You're not eligible for payment. See eligibility in general. That's why you're not getting it. That's not the one I want. Why can't I get my status? Because you're not entitled to it. You've been a bad boy. Oh, wait a minute. That's Christmas. Okay. Let's see. Error messages. Bank account info is wrong. Direct deposit.
That's all how to check on it,
Okay,
isn't
so that's checking on it. So we're going to go a different way. We're going to go to the Economic Impact Payment Information Center. Click. Returning it. There we go. Kind of see where I'm flowing here?
second to last.
Topic I, second to last, returning the economic impact payment. Question I1, what should I do to return a payment that was received as direct deposit or paper check? Write void if it's a check, mail it, include a brief explanation. They probably should say, write up an explanation before you mail it, but if it came by paper check and you've cashed it, then send your check to them and it gives you all these addresses to send to based on where you are, and Connecticut is Kansas City. So you'd be sending it down to Kansas City. But that's if you received a payment that you're not entitled to. So now I want the questions.
Who's entitled?
How do I return it? That's not it. I want to know who's entitled. So I'm going to do back and go to
Top one is eligibility.
eligibility. Who's eligible, who's not eligible? Not eligible. Income item. Now here's my decedent, my estate, and IRS has added the words decedent individual. This is not on the code, but an estate is in the code. They can't get the payment, so estate should not have got it. The decedent's estate included. Here's the dependent. You can be claimed as a dependent on someone else's return. You should not get this credit.
Doesn't say you were.
Doesn't say you were claimed. It says you can be claimed. So that's the eligibility issue of people not eligible. So those are the ones that are not entitled. So if anybody on this list received the payment, they should send it back.
One of the hard things in the beginning, when people got the payments for the deceased, the spouse that died on a joint return, there was nothing set out. And so we may have given information to the client that we have to retract or tell them differently. Because in the very beginning, when they got it, there was no mention specifically about returning the deceased person's amount. So husband and wife filed a joint return. One of the spouses died either in 19 and they were basing it on the 18, or they died in 20 and the IRS hadn't come out and said anything. So you may have told them something like, if you don't feel like you should have gotten it, do something nice with it, you know, donate it in this bad time, things like that. Since then, the IRS has come out with that directive. So you may have to go back ethically and say to the person, you know what I told you? IRS has kind of changed their position on it. You really should send it back. Now, again, it's up to them to do what it is, but you have to do what ethically you feel is in your best interest.
Are there other questions on those stimulus payments?
I have here, client did not qualify for the EIP in 18, but did for 19 that was filed in late March. She will not be eligible in 20. The payment never came. Is there a way to track it down? Website says we can't determine right now.
So, okay, when they determine the amount that goes out to people, they did it based on the 19 return. On the particular date that your name got picked to get your money, if there was no 19 return, they'd look for an 18 return. If there was no 18 return, they look to see if you're getting Social Security, real retirement, or any of the other provisions. So it was the day that they picked that name to determine whether or not they would get the money. You indicated that they had filed an 18 return and they filed a 19 return in late March, which if it was electronic, I would assume the IRS would have picked the 19 return. But let's just assume that the 19 return was processed completely after that person's name had already come up. In that case, they would have done it based on the 18 return. And if the taxpayer's 18 return income was too high, they got 0. Then when they file their 2020 return, they're going to look at the 2020 return to see how much income and stuff they have, determine if they get a credit, and they will subtract the 0 they got up front. So if there's nothing because their income is too high in 2020, they're going to get nothing. So if they had high income in 18, low income in 19, but didn't get processed in time, and high income again in 20, they're just not going to get it.
In short, the answer to your question is no, there's nothing you can do about it. Because the real credit is based on the 220 year. And it was just because they wanted the money out earlier that they had the opportunity to get it ahead of time based on other criteria at that time.
So the best we can do is try to get their income on the 2020 return lower so they can get some credit, if that's beneficial when you look at everything on the tax return and all future impact and that kind of stuff. But no, you cannot say, if I'd held off on filing 19 return till later, it would have been based on 18, they would have got more money. Tough. If I'd, in this case, if I'd filed 19 returns sooner, they'd have got more money. Tough. If I'd filed before the spouse died, they'd have got more money. Tough. That's just the way it works out. But instead of making us wait until 2020 and everybody get their real amount, they gave us all this money up front and created all these potential inequities and such as tax law.
So somebody has asked, if the taxpayer has not returned the $1,200 for a deceased husband, can that be reconciled on the 20 return? In other words, can she pay back through the 2020 return or? Yeah.
Currently, there's no provision on the 2020 return to pay it back. The draft, I believe the draft is out. Yeah, the draft is out. I've looked at it. There's no place on the draft return to send the money back. There's only a place to get the rest of the credit if you're entitled to more. So the only way to send it back currently is go to the IRS website on that economic impact payment and send it to Kansas City with a note explaining person died before the money came and here it is, and I'm being a nice guy.
I haven't been able to sleep at night.
Anything else on those economic payments?
I don't see anything in there.
Okay. So looking at the questions that you sent me ahead of time, and you got a print of them too? Good.
Yep.
You want to start at the top one?
Sure.
Okay, so Mary's going to read the question that we got ahead of time, and we'll deal with that, and then we'll take probably another one off your screen, and we'll kind of alternate between them if that works.
We have heard that there have been audits on the American Opportunity Credit for the final spring semester if the tuition was not paid in that tax year. i.e., if we have a college or a student that paid for the 2020 spring semester in December of 19. This happens a lot because the colleges expect payment before they can register for classes. So parents try to pay it prior to January. With that being said, can you fight that, or is that a done deal and the IRS will throw out the credit? So let's address that one first. The American Opportunity Credit, or the Lifetime Learning Credit, is based on the tuition that was paid during the year. So as long as the tuition, there's a box on the 1098T that says, let's see, the tuition paid, it could say that this might include classes that were paid that occurred in the following year if they were paid in the last 3 months. The credit is strictly based on what you have paid during that year, regardless of whether it belonged to the fall semester or the coming spring semester. So if the IRS audits the credit and you can't prove that those checks have been written in that year, you will not, they have the right to change the credit. And based on what we've seen, there is a lot of improper credits being claimed, far more than I ever thought would be the case. And so that's why the IRS has focused so much attention on it. David has the 220 1099T pulled up, the 220 1098T,
2020.
the 2020.
Okay, we'll get you right here.
All right, 2020, 2020, yeah.
Anyway,
Box 7 says, check if the amount in box 1, and the amount in the box 1 is what they've all exactly correct collected, is for an academic year beginning in January through March of 2021. Remember that the law is written such that you're able to take expenses paid as long as the classes are incurred within the first 3 months of the following year. So the answer to your question is there's nothing you can do about it. It has to go along with the actual year that it's paid. The rest, do you want to say something?
yeah, I want to go to back to my computer here. Yes, forgot where I was going. I want to go here. No. There it is. This is the Internal Revenue Code, Code Section 25 Cap A, which is where the AOTC and the Lifetime Learning Credits go into play. And there's a part on here that people tend to forget. We talk about it during the seminars, and people still tend to forget because we don't run into it as often as we think. And I got to get down to the right section. Okay, went too far. Let's see, I'm talking about the stuff that was prepaid. Eligible student restrictions, improper payments. Let's see, where's my,
Special rule for determining expenses.
where's that at?
Up,
I went too far,
go up a little bit.
right here?
Yes, does it have it in there?
That's not the one. It must be up in this area here.
Student.
Got to be at least half-time student. You only get it 4 times.
The IRS seems very good at monitoring that 4 times. And in fact, this year we saw one of our clients receive a letter after they had claimed it for the 3rd time, saying that the IRS was giving them a heads up that you only have 1 more year of eligibility left. And I think that's the first time we had seen a client get a letter of that nature.
Should be in this area in here.
Maybe if it's in the regs.
Okay. Well, it's temporarily escaping me, so I'll just give you verbally what it says. It says that if you pay an expense in 1 year for classes that begin in January, February, or March of the new year, you get the credit the year the expense was paid, which is the earlier year. So in the situation the question said is that they paid in December of 19 for classes that started in January, February, or March of 2020, you get the credit for that in 19. You don't get the credit for that in 2020 because the classes were paid for in 19. And the question was asking, is there any argument to say we get the credit in 2020? And the answer, as Mary said, is no. Here it is. 25G, 25 Cap A, paragraph G4. If qualified expenses are paid by the taxpayer during a taxable year for an academic period which begins in the first 3 months of the following year, the period shall be treated as beginning during such, in other words, first taxable year. So that's the part that says, hey, you get it in 2019. If we go to the beginning of Code Section 25 capital A, it tells us that we get the credit, and American Opportunity Credit in subparagraph B is saying you get it for any taxable year, the sum of 100% of the payments paid by the taxpayer during the year. So looking at the code, we feel the code is very clear. You got to make the payment in the same year the classes start. With the exception of January, February, March, it's treated like it started the prior year if you made the payments in the prior year. So I don't think we have any argument at all to say that we get this credit in 2020 since they paid it in December.
The second half of that question, I think, has already been answered, but I'm going to read it anyway. On the flip side, if you have a student who is starting college in the fall of 19 and the parents pay the tuition in full for that fall semester and the following spring semester in December, can the payments be applied to the American Opportunity Credit for 19? And in fact, the answer to that is that they must be applied. Now that the 1098Ts are mostly accurate, the 19 1098T is reflecting the payment of both those semesters on line 1, but indicating with the checkbox that for some payments they were made for the 2020 year. And I think that's exactly what we've explained. That's the way it has to happen to be consistent with the law.
Okay. You got one on the chat list that you want to go before we go back to our paper?
Not at the moment.
Okay. So the next one on the paper is when and how are taxes affected by the partner's share of unrecognized 704C gains, losses, and changes reported in item N of the partner's capital account analysis of the K1s. Okay, let's reword that. I got a K1 for a partnership. The capital account is supposed to be based on tax basis. However, for years, we've been able to use GAAP, 704C, tax, or other. Well, it's supposed to be tax basis starting in 2018. And if it's not tax basis, you're supposed to tell the partner what the differences are. Well, then they gave us a break. And they said start in 19. And then they said, well, just tell them what the differences are. And we start in 20. So starting in 2020, capital account on the K1 has to be based on tax basis unless they give us another reprieve. But in 19 and 18, if it did not based on tax basis, then the partnership was required to tell us what the differences were between the method used and what the tax basis numbers should have been. So if the capital account was based on 704C, they would have said, here's the extra income or expenses or whatever. That is the difference between what it would have been if it had been done on tax basis. That's just information to help us understand the capital account. And maybe to try to get in link with what the real basis outside should be. 704C is probably supposed to be done on most partnerships. It's not done very often because every time we teach it, everybody's eyes glaze over within 5 minutes. So at the risk of your eyes glazing over in 5 minutes, I'll give you a quickie of 704C. 704C says, you put in assets, I put in money. I'm entitled to depreciation based on my amount of money that went into the company, limited to my share of those assets, as if I had bought those assets, my percentage for money. I get the depreciation based on that amount. Whatever depreciation is left is going to go to you who actually put the asset in. Now, that's a brief 704C. It doesn't happen very often on tax returns that I've seen on partnerships. They just don't do it that way. But that's what's supposed to be done. So if the K1 capital account is based on the basis of the assets going in, and the other one's based on cash that went in, and they're doing these adjustments under 704C on the capital accounts like they should, all they're doing now is telling you what the catch up is. This is what the differences are. So every year the K1 would have 704C adjustment differences and taking that into account to come up with the income for box 1 and box 13 and so on. If it's in the capital account and that's the only place it's being referred to, you can basically ignore it because it's only used for capital account purposes, not for income or expenses.
Do you think the idea is putting it on the tax basis that you can see the basis from?
Yeah, Mary says the idea of having that information there is just so you could take the capital account on the K1 and convert it to a tax basis and be reasonably accurate. Still better to start with where you began with what you put in and figured over all the years based on K1.
If you do, well, even if you don't, if you have if you have shareholders that are filing their individual returns, you know, for the last 2 years, that if you have an S corporation shareholder who has had losses, distributions, or repayments of loans, those K1 or those worksheets had to be attached to the individual's return. The partnership has never required that, or at this point has not required that, but it seems like this change to reporting basis on the K1 or capital account based on basis, or the use of the Form 6198 to substantiate that, is IRS's way of making you prove basis or show them basis in the same way they do for the S Corp.
Okay.
A question regarding partner basis. If you have a recourse loan, does that add to the partner's basis?
You want to?
Okay. Yes.
And no.
That ain't good enough? Okay. When you're looking at a partner's basis, if it's a recourse loan, that is part of the partner's basis. It is also part of the partner's at risk. And that's an issue that sometimes gets confusing because you have basis and you have at risk. In most tax professionals look at risk because that's the amount that we use to determine if we can take a loss off on a tax return. At risk includes recourse debts and qualified non-recourse debts, which are on the Schedule K1. There's 3 debts: non-recourse, qualified non-recourse, and recourse. Recourse and qualified non-recourse are both at-risk amounts. All 3, non-recourse, qualified non-recourse, and recourse, are basis amounts. Now, since we really care about the at-risk amount, because that's what we're allowed to use on the tax return for our number to write off losses, we generally only care about the recourse and the qualified non-recourse. Typically, we don't care about the regular non-recourse because it's not part of at-risk and it's never going to impact anything on the tax return. There is one time that I can think of that non-recourse, which is part of basis calculation, but not at risk. There's one time I can think of that can make a difference. When you get out of the partnership, all three of the debts, non-recourse, qualified non-recourse, and recourse, are added to what you sold it for money-wise to determine your total sales price. So upon IRS audit, they will take the non-recourse debts that you're no longer liable for and call that part of your sales price to determine your gain or loss on your 8949. So if we're not including the non-recourse in our basis calculations, we're going to have a bigger profit when we close down if the IRS sees that some non-recourse got removed or terminated down to zero. So we really should use that for basis. But for at risk, it's just recourse and qualified non-recourse. Now I'm going to go out to the IRS website. So I'm going to share. Let's see, that's the code section. I don't want that. I want the IRS website. So back to irs.gov. I'm going to go into the forms. This is Schedule K1 for 1065. Okay, that didn't work. So let's get rid of the word schedule. Schedule K1 1065. There we go. This is the 2019 form. Our debts are right down here. Blow that up. Line K, non-recourse, qualified non-recourse, and recourse. All three of these are basis. Only the second and third are at risk. And we need to be keeping basis as well as keeping at risk numbers. Does that answer the question that they had? I'm gonna get out of sharing.
I'm going to hope it answered the question.
Okay.
Okay.
All right, back to the pre-set or the pre-given questions. The next one is on an irrevocable trust. A client has a two-family home where the owner lives in one half and the other half is rented out. In 2019, the home was placed in an irrevocable trust. During 2019, there is no rental income. In 2020, the rental income and the 50% of the home expenses will flow into the 1041. How does the expenses, tax, insurance, landscaping, snow removal, etc., pertain to the owner's percentage get paid and listed on the 1041? If the individual places their primary home into an irrevocable trust, what's the value of the home that the trust picks
That's
up?
a separate one.
Okay,
Look at the first one first.
all right.
Give me the question back.
Okay, the question was, in 2020, the rental income and 50% of the home expenses will flow into the 1041. How do the expenses pertaining to the owner's percentage get paid and listed on the 1041? I think that's an age-old question, and I'm not sure I have an exact answer, more an answer of how I would handle it. If you're putting something in an irrevocable trust and it is benefiting someone, I believe it should be considered a distribution to the trusts, the beneficiaries of the trust. Now, if there is a rental property put into an irrevocable trust by someone, it would appear to me that they're shifting their ownership, that they're not necessarily going to be the beneficiaries of the trust. So for instance, parents put their home into an irrevocable trust. And oftentimes when we see people putting property into an irrevocable trust, it's saying, I don't want IRS or I don't want Medicare to be able to get it at that asset. I want to make sure it goes to my heirs. And paying personal expenses out of it is not proper. So if there are personal expenses paid out of it, I believe that they should be treated as a distribution to the beneficiaries, non-deductible expenses, but treated as a distribution to the beneficiaries. That would make any income from the trust taxable to the beneficiaries. I don't like this happening because I think this is always a quandary. What could also happen and not have that as a benefit, have it as a distribution, would be that the parents or the owner of the prior owner that is living in that property could be paying rent to the trust, and then the expenses that the trust is paying for that would just be the normal expenses like the rental property. So in essence, both parts would be rental property, and the expenses paid out of it would be ordinary and necessary expenses to the rental property.
So on the trust 1041 return, line 5, the Schedule E would show the rent for the half and the expenses for the half. Correct?
Agreed.
And then on the 1041, page 2, where you got your distribution deduction, the expenses that were paid for the benefit of the beneficiary, so they can live in that half, would show up on line number 10. So that the income would be passed out as a normal distribution to the extent of normal 1041 taxation. That would appear to be the rules that we would need to follow in this case. Again, we haven't been able to find that black and white in regulations or things of that nature from the IRS, but it does appear that any payments out of a 1041 for the benefit of a Benny are considered to be distributions.
And in this situation, the situation I described is the beneficiary is probably not the one benefiting from living in the home. So if mom and dad placed the property into the trust and made their children beneficiaries, therefore avoiding losing that property should they go into a nursing home or something like that, the benefit is going to the children, but it's mom and dad's benefit that because the children are the beneficiary, they're saddled with the potential income.
And that makes sense because the beneficiaries are getting the usage of the property for personal purposes when it's used by a relative, and still would be a distribution to them. So that is one of those, in my opinions.
Second half of the question.
So David,
Yep.
David and Mary, I have, for those of you who are using the chat function, I have dropped a Word document which has all the questions that they're reading to help you follow along, because I noticed they're a little long to, so if you could use that Word document as well as listening to them. Sorry for the interruption.
Do you want to finish the second question?
Okay, the next is part of that same question, which is the first page of our document. It says, if an individual places their primary home into an irrevocable trust, what's the value of the home that the trust picks up? And upon death of the owner, does the trust get a step up? Okay, now the key word here is irrevocable trust. So what's happening here is that the taxpayer is giving their home to the trust. That's a gift. Under gift tax rules, the basis of the home for the trust is the basis of the giver or fair market value, whichever is lower. So in this question, they said, well, the value is higher than the giver's basis. Does the trust get to use fair market value, or do they limit it to the giver's basis? And the answer is you use the giver's basis or the value if the value is lower, which is the same rules you do for any kind of gift.
Now, there might be a question here as what goes on the 709. What goes on the 709 is the fair market value for that purpose, but the basis is the purpose to determine gain or loss, the donor's adjusted basis.
Yep, so same rules for any gift of anything that takes place, except instead of making a gift to a person, you're making a gift to an irrevocable trust. It's exactly the same rules. Second part of that question says, okay, the person that put the house into the trust now dies. Does the trust get a step up in basis? And as an irrevocable trust or irrevocable, depends on how you want to say the word, the trust is the owner. The trust didn't die. Therefore, there's no change in basis. If, on the other hand, it was a revocable trust, which is ignored for tax purposes and treated as if it's owned by the individual, then the individual is deemed to still be the owner, and their death would give us a new basis equal to value on date of death. But that's a revocable trust. That does not apply in the case of an irrevocable or irrevocable trust. No change in basis due to death. The trust bought it or owns it, and the trust is not the one that died.
You want to go into the state issues with it? Irrevocable doesn't.
One of the benefits, side issue of that is when you put assets into an irrevocable trust, as Mary said, you do the 709 gift tax return. When you do the 706 upon the grantor's death, you're using the values from the 709. So any appreciation on this property is not included in the estate of the grantor when he finally dies. It's the value at the time that he put the assets into the trust. So many times these are put into a trust to save estate tax later in life. Right now, we don't have estate tax till you're over 11 million some odd numbers, which most of us are nowhere near it. President Biden's proposals to drop that down considerably. So if that indeed does happen, we'd have a lot more people subject to estate tax. So gifting this into an irrevocable trust now would preserve that basis, or that value for the later 706. So that's usually the reason this is done. A reason it's not done this way is because we don't get a step up.
Trade-off.
So it's kind of a trade-off. You got to decide which one's potentially better for the client, not knowing exactly what the future is going to bring or what the values are going to do. We all know real estate always goes up in value until about 20 years ago. Then, of course, things changed. Any questions on that one? Okay.
Anything else on the board that's not there yet?
Nope. Okay, so next question we have is when a primary home is sold after death, should the sale of the home be on a 1099-S in the deceased name and social security number, or should it be on the estate's name? And the answer is pretty simple when you stop and think about it a bit, is the deceased is probably not going to sign the closing documents because they're dead. So the only one that can sign off on those closing documents is the owner at the time of the sale, which in this case would be the decedent's estate, maybe a surviving spouse or somebody else that got a TOD, a transfer on death, and owned it immediately upon death. They would be signing off and the 1099 would come in their name. But where the house went into the estate's the one that should get the 1099-S. Now, the rest of the question, which is not there, and Mary and I have done a good job of trying to figure what the real questions are. The rest of the question is, it came in the deceased's name and social security number. How do we deal with it on the tax return? Well, the answer on the decedent's return is you show the sale and you show the basis equal to the sales price. There's no gain or loss. And that's called a nominee reporting, no gain or loss. And the decedent, which means the executor, is supposed to do a 1099-S from the decedent to the estate for the exact same amount, the same form and the exact same amount as the original 1099-S. That's how nominees are supposed to report their income, so that gets reported on the proper return. So it would go from the decedent's name and ID number to the decedent's estate's name and ID number as the recipient. And then the 1041 should show the sale, which means it would pick it up on the 8949. It would determine the basis, which in this case would be a step up or down basis, new value on date of death, and go forth from there. Any additions to that?
No, I can't think of anything.
Okay. Any other questions that popped up in relation to that? Okay.
No.
I'll read the next one. 2 clients who are single living together in one home. One client has a son living in the home. Her AGI is 342,000. The other client has 3 children that lives in the home, and his AGI is 181,006. Which one of the parties can file as head of household, or can they both file as head of household if they independently are providing 50% of the support of their respective children? This question is, again, an ethics question, or a question that comes down to how much information should you be asking as a tax professional to get at the real situation that's going there? It all depends on the relationship between the two parties that are living there. If the two parties are truly sharing expenses such that one person has their family in one part of the house, separate bedrooms, and they just share the common areas, and the other party does the same, then they both could be entitled to head of household if each one of them pays for more than 50% of their half of the household. If, on the other hand, it is a situation where the two people are in a relationship and they happen to share a bedroom and the kids have separate bedrooms, then you're going to have to look at that house as a unit. And the person who truly pays more than half the cost of all of the expenses is going to be the one with head of household, and the other one is going to be single at that part. The difficult part is getting to the relationship of the two people without insulting anybody.
Now, Laura, in your email box, I just sent to you a copy of an IRS SCA, Service Center Advice Memorandum. And it actually says bio on the top because I just grabbed whatever email I had from you right away.
Okay, got it.
That SCA 1998-041, SCA stands for Service Center Advice Memorandum. This came out in 1998, which was 22 years ago, number 041 of that week. This one says an unmarried couple or two people living in the same home could each be head of household. And it gives examples or things that the IRS looks at to determine if they are indeed two households versus one. Things that they look at in there is they've got their own phone, which nowadays is easy because of the cell phones and stuff. And I see you did put it up on the web there, right?
Yeah, I just got
Yep.
it.
You put it out on the chat box.
Yes. Is that
It talks about sending out Christmas cards. Each family does their own Christmas cards. They are acting as two separate houses. Then the IRS in this SCA says, yeah, they could both be head of household.
It goes back to.
But many times when you get to your ethics, as Mary said, and you got to ask the questions is, are they acting like one house? If so, you can only have one head of household person. And so who's ever paying more than half the cost of that house. So in many situations, and you say he and she here, and I realize I'm giving away my age, but when a he and she live in the same house, it's very easy to assume that they are indeed living together as a couple and not living as two separate households. And that may not be what's really happening, but that is commonly what you assume. So you need to ask the questions. And I had a friend of mine who was a University of Wisconsin student. And during the week, she had a tall guy with dark hair there. And on the weekend, she had a shorter guy with sandy colored hair there. And the neighbors were really questioning what kind of lifestyle this student was leading. The tall, dark haired guy was her brother. And the sandy haired guy that came on the weekends was her cousin. But they would go down to Madison. The brother worked there during the week. The sandy haired cousin worked there on the weekends. And they just stayed at their sister/cousin's house during the time. But people are questioning what kind of lifestyle she was leading. Well, we can indeed have two families in the same house for head of household, but you need to ask the questions. Are they acting as two or are they acting as one? But that SCA gives you at least some guidance from the IRS on it.
And it is based on code section 44 capital A. So they do use that reference in the SCA. Next one. I think I read that one, so you are. You get that.
Okay, next one's what tax planning recommendations do we have offering for people that work from home due to COVID? Well, I'm assuming by work from home due to COVID, you're referring to employees. And the answer to me is very simple. We want the employer to reimburse expenses as much as possible. If the employer is providing the expenses and reimbursing them, the employee has no income, but they're getting paid back for those expenses. The idea of taking office to home expenses doesn't do any good because as an employee, they're 2% itemized, which for federal tax purposes, we no longer get benefit of. So that's not serving any purpose. So I like the idea of trying to have the employer do an expense reimbursement for that. They may have mileage that they can, again, write off, but again, it's 2106, so it doesn't do any good for federal purposes. Let's see. I can't think of other suggestions for people working from home.
COVID has brought a twist to the working at home. And in our area, we're seeing different businesses that are really questioning whether they're ever going to go back to the actual business location. If that's a case, that's a required office in home, but unrelated to COVID, people have in the past had the choice of whether to work at home. And if you have the choice of working at home and we ever go back to the ability to deduct miscellaneous itemized deductions, and according to our law, which we may never happen, but the code that took away those, or the law that took away those, expires December 31st of 2025. So even though that's 5 years down the road, it's something to consider in the future, or not to put it too far out of your mind, that there is a difference between a person who is required to have an office in the home and a person who chooses to have an office in the home.
But if they are required to, especially with the COVID, I like the idea of trying to get the employer to reimburse the expenses pertaining to that space. Taxpayers giving up the space. They don't have the right to use it for other things because they got to reserve it for the business. I like the reimbursement. I don't see any problem with the reimbursement as far as it being income, as long as it's a reimbursement of the actual expenses. So that part of the utilities, that part of the mortgage interest on the property and so on, employer does have to have an accountable plan. One of the things that could cause problems that the employer may decide to rent the space from the employee. And if the employer rents the space from the employee, we've got a different set of issues. In code section 280, capital A, it talks about renting space to your employer. It also talks about 2106 expenses, and it talks about your vacation homes. It's all in that same code section. Part of 280 capital A says, I think it's C6 if I remember right, if you're renting part of your residence to your employer, you get no expenses other than interest and taxes. So if the taxpayer rents out part of their home to their employer, the taxpayer would pick up Schedule E rental income, take off the mortgage interest, take off the real estate taxes, and have no other expenses. That means in essence, they're paying tax on all the rest of the rent income. They don't get utilities, they don't get insurance, they get nothing else. I guess that's better than getting nothing and just having to furnish your own home. But it's something to think about because some employers are going to do that. As Mary said, many of the employers have sent the employees home during this time and said, work out of your home, don't come into our office. And they're continuing to do that. We got a decent sized employer in Green Bay that's actually sold their building, and the employees have nowhere else to go back to now. And so the employees are generally working from their homes. So let's get them some money to compensate for the loss of that particular room. Reimbursement if we can do it, rent if we can't, but be aware of the limitations on the rent. It's so easy to take all the expenses against the rent income when really we're not allowed them all.
Sounds good.
Okay.
That's the next one. All right.
I think we covered that one.
And I think that's probably could be considered part of the last one. At the top of the next page, has there been any change to the employee deductions? And the answer at this point is no, but stay tuned. We're either going to have a reinstatement of it after 12/31 of 25, or like things have happened in the past, it will be an extender. Or Congress could make it permanently disallowed employee business expenses.
Let's see, next one talks about self-employed person with a PPP loan payback. I think that we've covered. What did Dave and Mary suggest as a way to enter the forgiven PPP loans in our bookkeeping and on tax returns? I think we covered the tax return side. On the bookkeeping side, on the PPPs, I suggest that you show it as a loan because that's what it originally was. So cash in and loan due. And when the loan is forgiven, I'm suggesting to my clients, wipe out the loan and show it as PPP loan forgiveness. Show it exactly as that kind of a name. So when I look at their books, I know that that forgiveness income is the PPP, and I know it's not taxable and I got to do whatever else we do with it, like my negative expense. But I do want them to very clearly show it on their books as a loan until it's forgiven, and then move it to the income category.
I think one of the challenges that we're going to have this year is that if you're not doing the bookkeeping for your Schedule C businesses, you're going to have to make a concerted effort to ask them, did they get the loan? Because we're not going to see a loan forgiveness document, and we may have no indication if you don't see a balance sheet for these Schedule C businesses. And just out of thoughts, there are, I believe, 23 million Schedule C businesses in existence today, compared to about 1.7 million C corporations and 4.6 million S corporations. So we're going to run into a whole lot more Schedule C businesses that we're not going to have that document unless we ask.
So you got to ask the questions.
Can we back up a moment? We had a question, I think, about the previous, if we rent to our employer, do you do anything with the depreciation on the space being rented?
Okay, and that answer is no. 280 capital A, again, I think it's C6, says you get no expenses related to the rental income
Of your home.
of your home. Now, if it's a separate building outside, down the street somewhere, fine. You get normal rental situation. But if it's part of your principal residence, we don't get any expenses related to it. So no depreciation, no utilities. That also means you're not allowed depreciation when you rent it. So you're also not have been allowed depreciation when you finally sell it down the road. So there's none of that recapture type stuff because there was no depreciation that was ever allowed.
And now the next one, they're kind of popping up a little slowly, so bear with me. This is now back to the PPP. I have many June and September corporate clients who took the PPP. Do you feel it's safe to file those returns? Question mark. Certainly don't want to be filing amendments later.
Again, the issue that I have is if the loan was not forgiven as of the last day of the year, then it's not forgiven until the next year. So the first year we should have the expenses as we go. When it's forgiven, that's the year that we got to make the adjustment. So I have no problem filing a June or September return with a loan on the books as a liability because that's what it is on the last day of the year.
Okay.
It's gonna be weird, the tax consequences.
Yeah, it's just going to be weird having it fall into 2 years is all.
And have the tax consequences of those expenses that you can't take the next year if you do have the loan forgiveness the next year, and it can distort things.
Next question that we have on our list is what are the options to help taxpayers get out of underpayment penalties? And do we want to present a couple examples using the 2210? Well, we did not put any examples of 2210 together. And I think the options is basically No, we got the annualized exception, which I've used a few times on clients, not very much lately, because the annualized exception basically says you got to know their income for each quarter. And if it's income that has a lot of, for example, stock sales, it takes a long time to break all that out. And I figured by the time I charge my client for all my extra time to do the annualized exception, it's going to be more than what the penalty is. So if we're talking a penalty of a couple $100, it's probably not worth my time to look at annualized if it's going to take any time at all. For the penalties that are looking at a couple $1,000, which I don't have many of, if any, maybe for them, the annualized exception would be worth looking at. Otherwise, I don't see a lot of help in getting rid of those penalties.
I think you're gonna pay the penalty, but it's the opportunity to make sure that there's tax planning so that doesn't happen in the next year. To either get your clients, if it is to change their withholding, or in the case of making estimated tax payments so that they have met the exception of paying 100%, or is it 115% of last
110.
year's tax, 110% of last year's taxes, if they're the higher income people. So I don't see any way of getting out of them. Keep in mind that this year, your software may have calculated penalties for underpayment. And if your software didn't change its date for underpayment to match the end of the year, the 7/15 due date rather than the 4/15, IRS could be sending some money back to your clients. So we've seen IRS send back little checks, and the little checks this year happen to be the underpayment penalty in some situations. So don't be surprised if your client says, why did I get a $10 check? And if you look at the return, the $10 equals the underpayment penalty that was put into the balance due by your software. And in some cases, it's because of the April 15th versus July 15th deadline.
One thing to remember on 2210 and 2220 is on the 2210 penalty, when we're looking at the prior year's tax, if their income is too high, we got the 110%. Otherwise, we use 100% of the prior year's tax. When it comes to a corporation, a C corporation, you only get to use the prior year's tax if there was a tax. An individual that filed a return that had a prior year tax of 0, 2210 penalty is based on that tax of 0.
Even if they didn't file.
As long as they filed a 12-month return. A C corporation must have filed a 12-month return and must have had a tax of at least $1. So when I'm looking at a C corporation and planning the estimates for the new year, I want to do it based on the prior year's tax if I can. If that's low enough, I will try to avoid wiping out the tax to 0. So if I have section 179, for example, and I can get the income down to $10, the tax is $2.10. If I wipe the income out totally, the tax is 0, and the estimates for the new year's got to be based on 90% of the new year's tax. But if I wipe it down to only $10 where they got a tax of $2, their estimates for the new year only got to be $2 to avoid all penalty. So on a C corporation, I try to never wipe out the tax. Now, psychologically, got to be a little careful. Many years ago, I got a taxpayer's income down to $10, and they had a tax of $1 or $2, and a client was not happy. What kind of a preparer are you? You couldn't wipe out a measly $10 of extra income to get me down to 0. So ever since then, I don't get them down to a couple of bucks. I get them down to where the tax is maybe 100 or 2. So then they got, say, $1,000 of income. The tax on that would be 210. Then the client says, well, we did pretty good. We almost got it down to 0, but we end up with $1,000 of income. That's not bad. But when I dropped it down to only $10, they were ticked off at me because I couldn't wipe it out totally. So psychologically, if we're looking at a corporation, get it down to a low number, but don't wipe it out too low, or you're going to have a client who's psychologically not happy with you. Individuals, we can use the 0. Again, it's got to be a 12-month return to be able to do that. Okay. I'm gonna pop up the question now, Laura, is, do people need to have a break here?
Nobody's moving now.
I'm thinking,
Anybody?
why don't, what, are you guys okay to have a break? I think,
I
yeah,
think we
I
could-
think everybody could use a break. I see some heads nodding here.
Okay,
Are you all right with that, David and Mary?
that
Yes.
sounds fine with us.
All right, so
How
it's
long?
11:51. Should we say, how long? Till noon?
Yeah, that's good.
Sure, that's about, yeah. That sounds
Okay.
good.
All right, everybody, get your martinis ready for the second bit. We'll see you soon. Back at noon.
Okay, we've got 9 minutes.
So far, so good, David and Mary. I know you're muted, but I think, yeah, go have a break.
G and put a big G in front of us.
Give me that pen there.
What thing? This?
Yeah.
Okay. That's from the
I just got to show you all this little lobster with a cheese head. Just for fun. Lobster with a cheese head picked up in, I think I did a seminar out in Maine. They thought this would be a good attachment for my office.
Yeah, I like it.
Yeah, I think it's something to do with the Patriots. Oh, you got teeth.
I want to know where you buy your ties, David.
Where I get my ties? Well, this is a Halloween tie. It's got,
Yes,
here you go. It's got little Halloween guys on it.
absolutely.
We like it.
Yeah. I figured if I wear a big G, people might not be happy.
But, all right, so just before we get started, everyone, some people just joined us. I can't keep track anymore if you already joined before, but just, you're all on mute. And until we get through all the questions, then if you have some more, we will allow you to unmute yourself at the end to ask a question. We'll see how that goes. If it doesn't work, then we'll go to another plan that I haven't figured out yet. And also, are you seeing the chat at all, David? There's a
Yes, we
couple
are.
questions that have popped up since you've been talking.
Yep.
And
we
then
do
there
see 'em.
were 2 other emails I'd sent you with other questions beside that Word document.
Okay.
Okay, so I resent one today and I can resend the other one again if you'd like it, just to make it easier so it's up in your emails.
Do it.
But-
You find it.
Okay, there's some, okay.
So if you want me to resend that other one, I was resent the one that came as a Word document or a PDF. I can't get that Word document to open. I would recommend the PDF.
Is this?
Okay, yep, that one I got the PDF. That's
Right.
on the sales and stuff.
Right, and then there was another one I'd sent you, I can't remember, but I can why don't I resend it again, just so it's in the top of your email
I have one,
about
Well, looks
PPP
the same.
compensation levels, but maybe we answered it.
the one email you sent me talks about a landscaper. And the other one's also about landscaper. So both the ones I got. Oh, sorry, same email. Okay, so I got the one on the landscaper, yes.
I'm just sending the other one, just so I make sure I'm not leaving anyone out and they don't come back at me later and say, hey.
Yeah, we want to try to cover things, so
So,
you want to get into that one?
Sure. Is that the last one?
Are we ready to roll?
I think we're ready to roll.
Okay,
Boy, that 10 minutes went quick, huh?
it did.
I think a review of helping clients who have gone through bankruptcy would be helpful. Maybe a review of short sales and debt forgiveness would be appropriate as well. Well, let's start with the bankruptcy side of it. There are 2 main types of bankruptcy for an individual, Chapter 13 and Chapter 7. There are 2 kinds of bankruptcies for business, generally a Chapter 7 and a Chapter 11. A Chapter 7 is a final bankruptcy. It means that there is no business anymore. A Chapter 11 and a Chapter 13 are kind of reorganizations. They're allowing people to offer not complete payoff of debts to finally get out of debts. In a Chapter 7 bankruptcy, I'm going to start with the business first. If a business files Chapter 7 bankruptcy, it means the business is over and done with. If it is a corporation, the corporation files bankruptcy and the assets are sold, the corporation is done. If an individual files Chapter 7 bankruptcy, it's a final bankruptcy, but from a tax standpoint, generally it's just an interruption for a minute. In other words, your client is a poor money manager or happened on some hard times, and they meet the conditions to file complete bankruptcy, Chapter 7. Generally, by the time they come to see you to do the tax return for the year, their bankruptcy has little or no effect on their tax return. In other words, their tax year starts at the beginning. It temporarily stops for a minute with the filing of the bankruptcy, and it continues through the end of the year. What that means is all of the income prior to the bankruptcy is included on the current year's return. All of the income that was incurred the minute after the bankruptcy to the end of the year is included on that return. And you file one return reflective of those two pieces. That's what happens to the majority of our people with bankruptcy. There is a special election that if you are aware of the bankruptcy and the individual has tax benefits, that it might be worth filing 2 short years. Now, before I talk about that for a minute, if you file bankruptcy and you have any tax attributes, capital losses, net operating losses, credit carryovers, the minute you file bankruptcy, those credit carryovers disappear on the last day of the year prior to the filing of the bankruptcy. So if you file bankruptcy in 2020 and you had any of those tax attributes, you would have used them on your 19 return when you filed it to the extent possible. And the rest of them that would carry over to 20 are gone because of the bankruptcy. They go to the bankruptcy estate, not to you. So when you file your individual tax return, none of those credits can be used on that 2020 return. However, if you happen to know about a bankruptcy in time to file the first short year return timely, that would be from the beginning of the year until the date of bankruptcy, you could preserve those to be used in that short return. So say, for instance, you've got a farmer and the farmer has had financial difficulties. And like a lot of farmers, they've been operating at a loss for a while and they have a net operating loss. And in 2020, prior to filing bankruptcy, they tried to do everything that they could do to stay above board. And they end up, prior to the filing of bankruptcy, selling all kinds of fully depreciated equipment. That fully depreciated equipment would result in a gain due to the recapture of the depreciation. If that taxpayer came to you before the 15th day of the 4th month after the filing of the bankruptcy, you could make the election to file 2 short years. That would be a benefit to that taxpayer who had a net operating loss, because in the short part of the year, with all of that gain from the sale of the equipment, that net operating loss wouldn't have disappeared as of December 31st, but rather as of the last day before the filing of the bankruptcy, which would be the end of your short year. So for most people, the bankruptcy for an individual is just kind of an inconvenience that you have to watch out for the loss of those tax attributes. Otherwise, if you have the strange situation, hopefully you're in on their potential filing of bankruptcy and you know about the short year election that could help them.
About the short sale thing. Yes.
Okay. The next part of it is debt cancellation. And I think, as with the PPP, the word debt cancellation's become fairly popular. We saw it a lot about 2008 through 2010 when the real estate market really went down and people were overextended. And with debt cancellation, there is a 1099-C that should be sent out. And David's going to share again the 1099-C that comes. When your client gets this 1099-C, an important part is looking at the date when the forgiveness, the cancellation happened. The next one is the amount of debt that was canceled. The third box is the interest that was a part of that debt that was canceled. Then there is a description of the debt that was canceled. Let's see. The next box says, was the taxpayer personally liable for the repayment of the debt? In other words, it was a recourse loan. Box 8, identifiable events. There are 6 identifiable events that could be part of that code, and they are in the instructions. Can you blow that up at all?
Sure.
Okay. The identifiable events would be a bankruptcy, B, another judicial debt relief, C, the statute of limitations on that debt, collecting that debt ran out. D would be foreclosure, debt relief. E is debt relief from probate or similar circumstances. F is an agreement that the debtor and the person holding the debt come to. G is a decision or policy to discontinue collections, kind of like the IRS does after 10 years. And H is other, the other category. So those are the kinds of things that you would see in that box 6, excuse me. And then lastly, box 7 is the fair market value of the property. So when you see a situation like this, there's a couple things that you have to recognize. Number one, you're looking at this as a debt cancellation. A debt cancellation generally does not mean the sale of property. It generally means that the amount in box 2 is taxable income. That's the general rule for it. The second thing is that if you don't want to pay taxes on the amount in box 2, which for a general taxpayer, the amount in box 2 would show up as other income on the Schedule 1 of the 1040. There are some exceptions to debt cancellation, and there is a Form 982 that is part of the picture that says, if I meet certain conditions, for instance, I filed bankruptcy and the debt was part of the bankruptcy, I am insolvent, I have qualified farm debt or qualified real property business indebtedness. Those are the 4 that exist. The principal residence debt says it was my principal residence. It's under $2 million and it is acquisition indebtedness. That one is part of it, courtesy of the extender bill, because it was supposed to have disappeared, but we currently still have that through 2020. So if, because of all the COVID, someone can't pay for their house and their house is taken back or a short sale, and the debt wasn't satisfied but shows up as having been forgiven, it is possible that that debt may not be taxable to them, even though it comes through on a 1099-C. So if box 2 of the 1099-C is the debt that was not satisfied by either taking the property back and the lender selling the property or a short sale occurring, that person would have that debt there possibly to be discharged. Now, there is another little catch to this form. And if this form is properly filled out And there is something in box 7. It says that this form serves 2 purposes. It is the purpose of putting together the 1099-A, which means abandonment, repossession, abandonment of your property, and debt forgiveness at the same time. So when you get a 1099-C, the first thing you probably should look at is box 4 to see what it was that was taken back. And if it is, and look at box 7 to see if there's anything in box 7. Because that signals that you have 2 transactions. One, the sale of the property, and the second, the debt that was canceled as a result of the property. So the 1099-A would have reflected the sale, and because it was all done before the end of the year, the 1099-A needs to be dealt with, and then the discharge of debt needs to be dealt with as well.
So looking at the form that I put up on the screen, I just typed in some numbers in box 2, 200,000, and box 7, 800,000. This tells me that this client owed $1 million right before this transaction took place. 800,000 of the money he owed was satisfied when they took the property, and 200,000 of his debt was not satisfied by taking the property. It was just plain forgiven. So as Mary said, the 800,000 is now the sale of the property. So we have to do our 4797 if it's business, our 8949 if it's principal residence, all the normal stuff using this as the sale of the property. And then we got to deal with the 200 and determine if it's taxable or if we have an exclusion, like she mentioned with bankruptcy, insolvency, on that stuff. So if this is done right, this client owed $1 million. So when I see a number down here in box 7, I always ask the client, well, according to this, you owe the bank about $1 million. Is that about right? And sometimes the numbers don't look like this. They look like this. Same number in both places. This tells me the client owed 1.6 million. And a client sometimes will say, no, I maybe owed 800, but not 1.6. And that tells me that the bank messed up. Because in box 7 should be the value of the property they took, as if the client had sold the property and given them the money. And box 2 should be the rest of the money that the client owes above and beyond the value of the property. So anytime I get something that looks like this, I ask them, did you owe 1.6 million? Or did you owe only 800? Or was there some other number? And many times the client gives me the age-old answer of, I don't know. So I ask them to contact the bank and get the information. Now that's kind of embarrassing for them because they call the bank and say, hey, this is deadbeat. What do I owe you? And of course the bank doesn't want to talk to them. So instead I ask them to get a hold of the bank and get a printout of their debt. What happened on that debt during the year? It would show what their debt amount was total, and it should show a decrease because of the value of the property that the bank took. So I'd always like to look at these 2 boxes. Now I just finished a tax return last week that had these numbers, the 200 and the 800. And over here on the left side was the taxpayer's name. And the wife got one exactly the same. Exact same account number, exact institution, exactly the same. And so I asked them, did you have 1 million forgiven? Or did you have 2 million forgiven because you each got a form? And their answer was 1 million. The bank has the right to issue the 1099-C to the taxpayer and the spouse for the full amount, which then on the tax return is a little confusing because we have to tell the IRS we only had one property that was sold for the 800. We only had one $200,000 debt that was forgiven, and then we have to deal with it. Typically, I would show one sale for double reported 1099-C and do the 800 in and out to come up with 0. The second sale for the 800 using its real basis. And I would use one 200 on line 21 for the debt that was discharged as double reported and back it back off. And I would do the second one with a 200 and show on the 982 if we have some forgiveness. But that's very common to get one for the taxpayer and one for the spouse. And it's very common that the amount in box 2 is the total debt, not just the debt that's left after the sale. But as Mary said, we always got to look at this down here to see if there's a sale of something. And that's a sale, and then deal with the amount in box 2 as the debt discharged. She wants the 1099A, so I'm going to pop up a 1099A. Too big.
This
Does that
is,
work?
this is often the form that people get when they have short sales and the debt hasn't been forgiven in the same year that the property was sold. So if the bank either takes, well, if the bank takes back the property, then the 1099 acquisition or abandonment of secured property comes along. And sometimes people are confused by looking at a 1099A and thinking that's the debt cancellation. And in fact, this is the property, this is the form that actually deals with the sale. And if you take a look at this form, the form has the date of taking back the property in box 1. Box 2 is the balance of principal outstanding. Now, if you think about David's last example, with the 2 forgiven and the 8, the fair market value of the property, the balance outstanding here would be the $1 million that he was talking about before. And then the property being worth 800,000. And when you look at this property, the rule for what do I report on the tax return for the sale, if the taxpayer is personally liable, which is box 5, checking a box in box 5, the formula says the sale of that property is the lower of fair market value or debt outstanding. And so that $800 that you saw in the 1099-C form is where they get that number from. And if you take a look at the difference between box 2 and box 4, if they satisfied 800,000 of the debt, there's 200,000 left that is potential debt forgiveness. But this form alone has nothing to do with debt forgiveness. So the property is taken back in November, we'll say, and that would be the date that shows up in box 1. And that property has to show up on the 2020 return as a sale. But the bank doesn't get around to forgiving that debt until 2021. And so the debt cancellation form that would accompany this would have the 200,000 on it and nothing in the 2021 year, would have $200,000 in the box of debt forgiven, and there would be nothing on the fair market value line of that matching transaction, so to speak, because this preceded the 1099-C and was all taken care of before we had to deal with the debt cancellation.
And something you need to, again, be careful of. This person that got this 1099-C, that's got this 800,000 in box 4, I mean 1099-A, they got the 800,000 in box 4. The bank may give them a 1099-C for the other 200 grand and to put the 800,000 in box 7 of that 1099-C. That means that the bank took 2 properties worth 800,000 each based on what they reported. So sometimes the bank will do this form as presented and do the 1099-C with the 800 in box 7. That means there are 2 properties that were sold. So the IRS is going to look for 2 of them sold. Banks commonly screw this up. And when you call the bank and say, hey, this is deadbeat, I want this corrected, they laugh at you. So we got to be prepared to deal with it on the tax return. And again, the big key is how much did the client really owe before all this stuff was taken away? and before the rest of the debt was canceled, which could be a different year, as Mary said. That way we can treat it correctly.
The key to explaining it to the IRS, the description of the property should say home at such and such address. And that should match what's in the 1099-C document as well. And so that would be a reason to help you know that they're the same property. And it would give you something to tell the IRS at the same, at the same site to make sure that it is the same property. You can't assume that the IRS is going to see the two documents and put the relationship together, because it's a computer that's reading the documents generally, not the human eye. So that's short sale debt forgiveness. The only thing with short sale to say, a short sale generally means you're selling it for less than you have invested in it. If you have a short sale and you have a loss, if it is a principal residence or personal property, there is no loss allowed. If it is a rental property that is short saled, there is a loss allowed on the rental property.
Anything else on debt discharge?
Nothing I can think of.
I see, Laura, that we got a question. It's the last one on the list over there. Because Mary talked about the short year election when somebody files bankruptcy. And the question is, how do you do the short year election thing? Well, briefly, you need to file the first 1040 return by its due date, which is 3.5 months after that year ended. Make sure you put in the fiscal year up on top. And it's got to be filed within that 3.5 months. And you have to make the notation that it's a short year election on the top of the papers. And then you need to do the exact same thing for the second one. Indicate that also with a fiscal year and indicates a short year return. The problem we often find is a client comes into us in January or February and says, hey, last year I filed bankruptcy. And we realize they lose the NOL from the prior year going into that final year, but they don't come in to see us until February or March. And by that time, we're way past the due date for that first return, which means we do not have a short year election. So unless they filed in, let's see, well, if they filed in October, that means they'd have to let us know by February 15. October, yeah, February 15th. Otherwise, we'd have no chance to do the short year election. And I'm thinking that's 1341. I think code section 1341 is the short year election.
I'm looking for it here. There is a publication that the IRS has on bankruptcy that contains the information. It's a publication 908 that you can find that, and making the election, no, it's 1398. 1398.
Yep, election is 1398, not the number I gave before.
1341 is the credit for.
Oh, 1341 is a repayment credit. Yeah.
1398 is the election. You can file an extension on that short year return. So if you know it happened but couldn't get the return done to meet that 15th day of the 4th month, that return can be extended and still make the election.
But you got to make the election on the extension then.
You have to make the election on the short year return.
And if you're gonna do an extension, you gotta do it on the extension, I'm pretty sure.
The election on the extension.
That you gotta do the election on the extension. So if, again, somebody filed in April and they're telling you now, you're too late to do short year. I'm
Right.
pretty sure it's gotta be done on the extension or the return filed by that 3.5 month date.
Debtor can elect to end the debtor's tax year by filing a return on a 1040. For the first short year, the return must be filed on or before the 15th day of the 4th month at the end of the first year. But that could also be, you can do the extension for it.
A question that popped up down there talks about the 1099A and 1099C. What happens if they're different dates? And That's common. They would take the property away now in October of 2020. And that would be a sale. And next year, they may forgive the debt. So anytime we see that 1099-A that says property was taken, we need to be asking them, did they forgive the rest of the debt? Assuming there's still some left. Did they forgive it, or do you still owe it? And if it ends up a different year, it ends up a different year. So there's not a problem having different dates, one for the seizure of the property to satisfy part of the debt, and one for the rest of the debt that was forgiven.
One other thing that we've suggested, sometimes the clients are reluctant to go back to the institution because if they haven't forgiven the debt, it stirs up the possibility of them coming after them, whatever in their mind. But if that taxpayer goes out and pulls their credit report and that debt is still listed on their credit report, chances are it hasn't been forgiven.
We have a couple of cases in our files where a taxpayer merely had credit card debt that was forgiven. And we have them in our files as cases to share with people where the court determined it was not forgiven. I'm thinking one of the names was Sims, S-I-M-S. And Mr. Sims had a Discover card and he got a 1099-C that said the debt was forgiven for like $4,000. It wasn't a big amount. He did not put it on his tax return, and the IRS, of course, sent him a CP 2000 and audit and determined he owed the tax on it, and he took him to court. And the court's final decision was, Discover, you said you forgave this guy's debt. And yet, when I look at his credit report, the debt is still there. So did you forgive it or not? And Discover didn't have an answer. Then they asked the IRS, why did you say he owed money on this forgiven debt? And the IRS said, because Discover kicked out a 1099-C. And the court said, well, since Discover still has the debt on his credit report, that means it wasn't forgiven as of that point in time that you're trying to assess the tax for. So therefore it was not forgiven debt and he did not have income. So the timing of when it was really forgiven means it's really forgiven. If it's still on the credit report, it wasn't forgiven yet. You can use that as an argument in court to show that it was not forgiven because it's still sitting there as a debt.
The other case had the debt should have been forgiven years earlier, and it was out of the statute of limitations.
Yeah, there was another one similar, and the debt was actually forgiven an earlier time than when they did the 1099-C. They just finally sent out a 1099-C when they got around to it. And since that year was in front of the court, the earlier year had already passed the statute. So the court ruled in favor of the taxpayer. You did have debt forgiven, but it wasn't that particular year. It was an earlier year. That's closed for statute. So in essence, the taxpayer had debt forgiveness that was tax-free. Tax-free only because he didn't report it and it was past the statute for the IRS to collect. Anything else on the debt discharge?
Well, there's two questions about insolvency there. One,
Okay.
but one was sent to me privately that I just put in there. In figuring out insolvency, you calculate the assets and liabilities as the day before the debt discharge? I think that's the question.
When you are figuring insolvency at the point when the debt is discharged, the taxpayer has to be insolvent. So what you need to do is the minute before the debt was canceled, you take a look at all of the value of the assets and all of the debt that was owed on all of the taxpayers' properties. And if there is more debt than the value of the assets at that minute before the debt was canceled, there is potential insolvency to the extent of the difference between those two numbers. So it's the minute before the debt was forgiven, which means that that asset is part of that, as well as the debt on that asset is part of the calculation. Now, one other little warning in debt, in insolvency. Some people are not able to meet the insolvency test because your retirement plans are assets that you have to consider when you're measuring insolvency.
Taxpayers have tried to argue in court that you don't get to count retirement assets because a creditor can't get at them. And the courts have determined that, no, Congress didn't say only creditor accessible assets. Congress said all assets. A case many years ago involved an Alaskan fisherman. He had a license to fish the waters around Alaska, which at that time was worth about $450,000. Other than that, he had very little assets. And the court determined that he had to pay tax on his debt discharge because he was not insolvent, because you had to take that $450,000 into account. So even though creditors can't get at it, like retirements or that Alaskan fishing license, you got to use all assets. And in the years that we've had these, we have had a couple times that the IRS has come back and said, thanks for your 982, thanks for telling us you're insolvent, prove it. And the client had to come up with their credit cards, their bank loan documents and stuff to show what was owed as close to that forgiveness date as they could, to show what their total debts were and their total assets. So it's not just a simple exclude it, it's a you may have to prove it. Now, Mary and I do disagree a little bit on how we file that 982. I say insolvency if it applies and properly reported. And if I remember right, Mary likes to attach a list of their assets and debts.
Just to avoid the IRS coming back or potentially to ward off the IRS coming back, I usually attach a statement to the tax return showing a list of the assets, showing a list of the debts, and the fact that there is enough debt to satisfy the fact of non-taxability of it.
In the last 20 years, how many times the IRS come back and said, prove it to you?
For me, not.
And I've had it twice. So maybe doing what she does is a good idea. I'm stubborn.
There's nothing in the law that says you have to do it that way. We just look at it a little differently. And one other issue we had in the past is that sometimes the IRS will come back and say, where's your 982? Because at some point, we feel that the software may not have included the 982 in what was electronically filed. Now, that was a few years back and we haven't had the situation again. So I think maybe it was a software issue that was corrected.
Is there another question on the debt discharge?
This one is, what is the life of a balance due to the IRS? Is it allowed to be discharged in bankruptcy? And also, is the debt to the IRS ever forgiven to the IRS, and under what circumstances?
Okay, there's a couple different parts. The first part is how long does the IRS have to collect the debt? And that answer is 10 years from the assessment date. They have the right to collect the debt from 10 years from the assessment date. It's not the day you filed the return. It's not the day they did the audit. It's the assessment date. So you almost got to get the transcript from the IRS to get the right assessment date. And it's usually not on the normal transcript. It's on the tax doc.
Tax mod A.
Tax mod A, TXMODA. TXMODA. I say tax mod A, but that first letter A is not there. TXMODA will give you the true assessment date. And when you call the IRS with your power of attorney and ask for that, they're usually going to say, what are you talking about? And then when you say, I need the tax module A, then they will usually say you're not entitled to that. And then you would say, I got power of attorney, I am entitled to that. They will finally get it to you. So it's not something that's easy to get, but that will give the true assessment date. Then the IRS has 10 years from that date to collect the tax. If they cannot collect the tax in that 10 years, they're out of luck. They do have opportunity to ask the taxpayer for an extension, in which case the collection period goes longer.
43.
And if the the taxpayer files for an offer in compromise, it automatically extends their assessment time or their collection time. So if you do an offer in compromise, whatever time the IRS is considering that, they're not allowed to collect during that time. So that gets added on to the end of it. And once that time is over, the offer and compromise, they get a minimum of, I think it's 6 months after that to still collect. So you do an offer and compromise with a month to go, you just extended the IRS's time to collect it to 6 months after that is accepted or rejected. So I don't do an offer if we're down to the narrow last 6 months of the thing. But that's the normal collection time. Agreed?
Yes.
The rest of that question was, can it be forgiven in bankruptcy? And the answer is yes. Income tax debts can be forgiven in bankruptcy if the conditions are met. There are 3 conditions. Number 1, the tax is from a tax return that is more than 3 years past its filing deadline. So the 2019 return, okay, forget 19. 2018 return was due April 15th of 19. 3 years later is April 15th of 21. So that return has to, the tax on that return has to be bankruptcy filed after April 15th of 21. So more than 3 years after its unextended due date. Test number 2, the tax return had to be physically filed more than 2 years before the bankruptcy filing. So the due date more than 3 years before bankruptcy filing, the filing of the return more than 2 years before the bankruptcy filing, and test number 3, the tax had to be assessed more than 240 days before the bankruptcy filing. Now, if you think about a return being filed more than 2 years before the bankruptcy filing, of course that tax was assessed more than 240 days before the bankruptcy filing. That's a no-brainer. But if the IRS did an audit on any of those returns, that assessment from the audit is only excusable in bankruptcy if it is indeed more than 240 days since that audit assessment took place. So 3 years from the filing date, filing due date, 2 years from the actual filing date, and 240 days from the assessment date. If you meet all 3 of those, then it can be discharged in bankruptcy. Otherwise, it's not. And we're talking income taxes. We're not talking withholding taxes, because withholding taxes will stay around forever. They're not going to go away in bankruptcy.
Sounds good.
And something just popped up. Oh, all right. Taxes due and bankruptcy is a 1040 that is meeting these tests, but the tax returns were filed late. I've read that these late returns can be considered not a return because of the late filing. Comments?
Well, to get them forgiven in bankruptcy, the returns had to be filed within, or at least 2 years, or should I say more than 2 years before the bankruptcy filing. Can the IRS ignore that return and consider it not to be a return? I'm not aware of a return being filed late not being considered a return,
As long as it's with it after that 2 years.
as long as it's a real return. If it's an SFR, substitute for a return, that's the situation where the taxpayer did not file and the IRS filed a return for the taxpayer based on 1099s and data that they had. That is not a return the taxpayer filed. That is not going to be forgiven in bankruptcy. The taxpayer is going to have to file the return and then wait at least 2 years before they'll meet the 2-year test. But I'm not aware of a filing of an actual return by a taxpayer not being considered a return. So I'm not sure what the what that reference is, and I don't know everything, but I'm not aware of that issue. Anything else on that one?
I think that's it on, Victor says it was the bankruptcy court that made the ruling.
And that would be good to know if you got a case name or something, we could always track it down and
Good work,
try to
Victor.
learn more. 42 years in this business, I'm still learning.
Okay. And then he says, thank you. And then, of course, there's a question that I think is now taking us off the topic. Do you want to continue with yours or read this one?
Go ahead with what you got.
I have a question on police officers who retired on a disability pension and all or part of the income has been treated as tax-free. If the person on disability dies, can the surviving spouse receive the same tax-free treatment on the disability payments?
I don't think so because it's workman's comp.
As you can see, we're talking to each other here in this thing. We're actually deciding what to have for lunch. Okay.
No.
The answer is, we don't know.
All
We
right.
believe that the exclusion is not available for the survivor because it's only available for the taxpayer who's the one that's disabled, but we don't know for sure. So I don't have a definitive answer for you on that one. Some things we do know, like housing allowance for ministers is available for the minister, but when they die and the spouse gets the exact same thing, they do not get the right to use the allowance. So things do not always carry from one person to another when they inherit it. I do not know that one specifically. Disability payments, I believe, falls under code section 104. So there may be an answer in that or in the cases under that, but we don't know off the top.
Isn't it the one that's in the nature of workman's comp though?
Let's see, disability, that could be, and this could be the one in lieu of workers' comp, which could be what Bill is referring to there. And I don't know why workers' comp would be given to a surviving spouse.
But if you're getting your retirement and it was a service-related injury, it's not taxable because it's in lieu of workman's comp.
The in lieu of workers' comp rules are a little weird to some extent. You always have to look at the municipality to find out on what basis do they decide to make the payment, whether it was a retirement basis or a injury basement or a work-related injury illness basement. Because if it's the work-related, then they get in lieu of workers' comp and it's tax-free, but I still don't know if it applies to the surviving spouse.
You wouldn't get workers' comp after someone died, but you would get retirement.
You wouldn't get workers' comp after someone dies?
I don't think so. I think it dies with the taxpayer.
Makes sense, but I don't know.
Yeah.
So we'll have to leave that one as a don't know.
You've got-
We're- I think we're back to the questions you have now, guys.
Okay. I did see another one on your list. I'm going to scroll up the list. And it's something to do with rental, and they did their own home or their own returns.
Yes.
Let's see.
It was
Look
a-
at
Okay.
1152.
Yep, at 1152. And below that a little bit, right below that one, it says, can you repeat how to do these nominee 1099s? Let's cover that one, then we'll do that rental one right above it on your list. So I'm going to go to the IRS website, and we got a 1099-S is the one that this situation was. It involved a question that we had before where the person died, the estate sold the house, and the IRS naturally has got the 1099-S that's in the deceased name, even though they're not the ones that signed the papers. Up on your screen now, you have a 1099-S. So in the situation that they have described, you got the realtor, whoever's going to do the 1099-S here. We have the taxpayer's social security number and the taxpayer's name, box 1, date of closing, and the proceeds, and of course the address. When that comes in the name of the deceased and it was sold afterwards,
So the date of closing is after.
so
the
date of
death.
closing is after date of death. This part up here for the filing should be the deceased name. The filer's ID number should be the deceased social security number. The transferor's name should be the estate's ID number. And the transferor's name should be the estate name. Same date of closing and proceeds. So the right-hand side's all going to be the same, but on the left-hand side, it's going from the dead person and their ID to the estate and its ID. And that is the case for a sale taking place after death. It's the case for interest and dividends that were paid after death, but came in the name and number of the deceased, usually because the financial company was not told early enough that the person had died. It could be 1099-Rs. It could be 1099 miscellaneouses. Any of those that came to the dead person and are for payments after the date of death, the dead person is supposed to do 1099s from them to the estate or whoever the true owner is. Same thing if you have just two people own an account. Simple example, digressing a bit. My sister and I both own a savings account. We both put half the money in, so the interest should be 50-50. And yet the 1099 INT came to me. I'm supposed to do an INT to her with my name up in that corner, her name as the transferor, and show her half of the interest on the interest line of that 1099 INT. So anytime you're getting income on a 1099 of any kind that belongs to somebody else, you are supposed to do one from you to that person. I think that answers the question that you had there. So let's go to that rental. That was 1152. Let me back up to 1152. There we are. So I'm going to summarize that, Laura, instead of making you read that whole thing. Everybody's got it on their side panel anyway into the chat. The situation is, to summarize it, is taxpayer as normal did their own return and had no idea how to do depreciation. Now the taxpayers come to me because they sold the property. I know that I have to reduce the basis by depreciation allowed or allowable. So therefore I got to reduce it by the 15,000 depreciation that they missed. Is there anything I can do about that depreciation deduction so that she doesn't pay tax on all this money that she really got no benefit of? And I'll let Mary address that one.
The answer is yes. It comes to recapture or to be able to deduct that interest and get a benefit of it now. There is a form 3115 change of accounting method that is required to be filed in order to take advantage of it. The 3115 is an 8-page form that everybody hates, but in reality, there is only one section of that 3115. It is an automatic change of accounting, therefore it doesn't cost any money to do it. It can be done all the way up to the statute of limitations for that return, although we would suggest that you do it in the same year that this is happening. And with the 3115, there's probably 3 of the 8 pages that are required to be filed because there's general information and questions. And then there is a Schedule E, I believe, that is the last page of the 3115. That is the portion that applies to writing the depreciation portion of it. So in essence, by filing the 3115, they have a right to take all of the catch-up depreciation in the year of sale, or it could be in the year it was discovered, and it's the sale that's usually causing it to be discovered. So their Schedule E, after completing the 3115 and figuring out how much depreciation they were entitled to but did not take, their Schedule E would have that number as a deduction on it in the year of sale. And that's how their sale would properly be reported, as having the depreciation, the basis lowered by the depreciation as allowed or allowable. And then in that year, they'd be able to take all of that depreciation as a deduction on their Schedule E.
I'm going to throw a caution out there. And in this example, as it was written in the chat box, the taxpayer, it was Joanne, did the return in the past. She had done depreciation in the past, and the taxpayer did their own return and screwed it up. Joanne knows how much she took. She looked at the client's returns for the years that they were gone and realized the client took nothing. That's a caution. You can't just do a 3115 and take all the depreciation going back to the first day they bought that asset unless you know they did not take it. And if this client had gone to, who's the next one down there? Marion had a question right below that. So Joanne's client, who did their own return, then went to Marion. Marion looks at the 2018 return, sees no depreciation. And she asked the client, have you ever taken depreciation on the property? And the client says no. So Marion does a 3115 for all depreciation that could have been used going back to the day they bought this property. Marion may be in trouble as a paid preparer because she hasn't gone far enough to verify that no depreciation was ever taken. Because if she had the client bring in the returns, Marion would have seen that Joanne had done some depreciation in 2015 and before. So before you arbitrarily do a 3115 to catch up depreciation that was missed, make sure it was missed. And I think looking at those old returns is important. Now, if the client says, I've always done my own return and I couldn't figure this out and I never took it, I might be willing to accept what they say. But if I ask them and they say, yeah, I used to go to prepare years ago, I think it would be proper for the preparer to ask to see those old tax returns to verify that the depreciation was never taken. So that's just a caution thing to avoid you as a preparer getting in trouble by giving them a big deduction that you don't have enough proof that it was indeed allowed because it was not taken before. She
And-
nods her head, so she agrees with me.
And may I add that the form is complicated, but as members of the NATP, if you look under the education, there is a great course. I think it's on demand that you can do on how to fill this out. And I once did a tax return filling it out while I was watching this course on the other show, on the other screen, because so make sure you utilize those tools.
Yeah, the form is intimidating because it's so long. I popped one up on the screen. The first page, of course, is fairly easy. Depreciation check and what kind of entity they are. And I always like to give them the power of attorney. But the questions on the front, or excuse me, on the second page are basically, are you part of a consolidated group? Are you, number question is, are you audit protection apply? Next one, are you got something in appeals or court? One of the questions is, are you an audit? Do you got a letter ruling requested out there? Have you done a change of accounting method in the past? So most of the questions on page 1, 2, and 3 are basic everyday questions. We don't have to worry about non-automatic because this is an automatic approval.
Show them on the front page where they have to put a number.
Okay, Mary says go back to the front page. You do got to put in a DCN, which are the automatic changes. And depreciation, I believe, is a 7. And like Laura said, you can find this on NATP's website as well. Going down to page 4, the top part asks for your 481A adjustment. Here you would be entering in the example Joanne gave us, 15,000 as your depreciation to catch up as a minus because it's an expense. And you do take that all in the year of the change. You have no right to spread it. If that number would be a positive, like income, you took too much depreciation and you're trying to add something back in, then you spread it over 3 years unless you make an election down here, de minimis. You could take it all in one shot if it's less than 50 grand. But anytime it's negative, you got to do it in 1 year. And then we go to the rest of page 4. We're not doing that. We go to page 5. We're not doing that or that or that. We go to page 6, we're not doing long-term contract. We go to page 7, we're not doing cost allocation. We go right to page 8, we're not doing cost allocation, but we are doing change in depreciation. So we do have to answer these questions and attach a statement of the depreciation calculation they had and what the depreciation calculation should have been to help support that 15,000 number that Joanne had in her email or in her chat. So it's page 1, 2, 3, basically, are you in audit, collection, consolidate, etc. Page 4 with the dollar amount and answer the one question there, and then come back and do the last page, number 8. So it's not overly lengthy. It's intimidating until you've done a few. Okay. Continuing on to the questions that we had, it looks like a good time to do that. And the rest of the questions that we had were all on a separate sheet, and it's titled Questions for Coffee with the Mellems. After several years in business, the client's a landscaper. They're stopping the operations, and they still had a big diesel pickup truck, commercial grade leaf blower, and maybe some other items as well. From a tax standpoint, what's the most effective way of handling this equipment? and there are 4 different items that are being asked. So we need to know, first of all, what kind of entity was this business? Was this a sole proprietor? Was this a corporation? Was this a partnership? Because that makes a difference on the answer. I'm going to assume for our discussion here that this was a sole proprietor. So the first question is, the taxpayer stops the sole proprietorship. They got this pickup truck, they got this leaf blower, and they're just stopping the business. Is there any consequence from stopping the business? You're on.
Yeah. So if they're a sole proprietor and they stop the business and they haven't sold the assets, we assume they've converted the assets to personal purposes. And if they have converted the assets to personal use, then you have to ask yourself, do you remember what part 4 of the 4797 is for? And David's even going to pop up part 4 of the 4797. Part 4 of the 4797 says that if the business use of an asset that you still have drops to 50% or less, there may be some recapture. And the recapture comes in 2 categories.
Hold on, I'm getting to part 4. There we are on the bottom.
Okay. On part 4 of the 4797, there are 2 sections that are involved in a recapture of depreciation when you still have the asset and the business use drops to 50% or less. And obviously the business use is dropping to 0 if you're taking it out and using it for personal purposes. The first one is if you've taken 179 on the property. If you've taken 179, then you have to look at how long you've had that asset and decide whether it has to be recaptured. The second one is for 280F, which applies to listed property. If this pickup truck meets the conditions of being listed property, then you're going to have to recapture that depreciation that was taken in excess of, straight line, is it?
You got to recapture 179, you got to recapture bonus, and you got to recalculate depreciation as if straight line applied instead of regular makers, recapture the difference.
So for the 280F, for the listed property, even if you haven't taken bonus or 179, there is an amount of accelerated depreciation that comes into play on that side. So those are the 2 things that for the leaf blower, if you expense the leaf blower, you've got an issue in part A. If the vehicle is listed property, whether you expensed it or used bonus, you have an issue on that part, or could potentially have it. So that's the big deal to take a look at there. I'll switch back with you and you can play with your mouse.
Okay. I like to play with the mouse, so I get the mouse play. Yeah.
Okay.
Okay, the next part of the that same issue, that was number 1. It keeps the truck for personal use. If they did not keep it for personal use, if they just kept these assets and did not use them personally at all, and they just sat in the corner until they could find a buyer, then we don't have this recapture stuff that Mary just discussed. That applies if they change it to personal use instead of business use. The second part of that question.
Okay. That they didn't use it for personal purposes.
They did not use it for personal purposes. They just let it sit in the corner.
Yep.
Then we don't have the recapture. Second part is he sells the power rake a year or 2 later for $1,000. The cost was 3, basis was 0. And we'll assume this recapture did not exist, make it easy for the rest of these questions. If they paid 3 and fully depreciated it, they sold it for $1,000 later down the road, how and where is it reported? Well, since their basis was zero at the time they stopped the business, if we don't have recapture of any kind, their basis is still zero. So when they get the $1,000, it's still income. Is it ordinary income? Exactly, because it's due to depreciation. So it's still going to be depreciation recapture and picked up as ordinary income. The only way that taxpayer would have anything that's not ordinary income is if they sold that rake for more than the cost of $3,000, then the extra would be capital gain. Otherwise, the depreciation recapture hangs on forever until the taxpayer dies. Then, of course, you get a new basis and that kind of good stuff.
In this case, even though it's sold in later years, if they haven't converted it to personal, it's still a business asset, and business assets are still sold on 4797.
If the power rake had been converted to personal and we still did not have any of that recapture stuff, just keep this example simple, then in the taxpayer's hands, it turns into a capital asset as opposed to a business asset, but it still has the depreciation recapture issue to deal with. So if they had converted to personal, we'd put the sale on an 8949, but then we still got to pick up the depreciation as ordinary. And I have not yet figured how to show something on the 8949 and have the depreciation show up in 4797 part 2. So even if they do convert it to personal, I would still show it on a 4797 part 2 or part 3 and do the recapture as normal.
Okay.
Third one, in a couple of years, he sells the leaf blower, cost is $1,700. He had $1,320 of depreciation. That leaves $380 remaining basis. Doesn't matter when he sells it. I think that's the same answer we just had. If he sells it at a gain, again, we got to have the depreciation recaptured. The question goes a little further and says, if he sells it at a loss, can he deduct the loss? Well, that one's not as clear, but if he has converted this to personal use, you can't have a loss on the sale of a personal use asset. You can have a loss on business assets. You can have a loss on investment assets. You can't have a loss on a personal use asset. So if he sells it at a loss, I would say he doesn't get any loss.
Agree.
Mary agrees with that one too. Number 4, he trades it away. The book says it's $4,000 and the dealer gives him $6,000 on a trade-in. What do you happen there? And by book says it's worth 4. I'm not sure exactly what you mean. If you mean the basis is 4 and the dealer offers him 6 towards trade-in, you got a sale for 6, basis of 4, you'd have a profit of 2, which of course would be depreciation recapture to start with. If you're saying it's fully depreciated, which looks like the words here, and Blue Book says it's worth 4, but the dealer gives you 6, now we got a little bit of a different issue. Now we have a dealership that gave you 6 for the trade-in value, but the Blue Book says it's worth 4 and we got no basis. Obviously we do have income, but the question is our sale deemed to be the 4 that Kelly Blue Book has? Or is the sale to be the 6 that the dealer gave you credit for? Well,
I would ask for more information from the dealer saying, what do you see the value of this vehicle? And because it could be the other 2 is dealer discounts.
I used the example that the dealer gave him 6. If the taxpayer had gone down to the dealer to buy the new property and would have got $2,000 off the price of the new property with no trade-in, that means that the property truck was really only worth the $4,000 difference. IRS, of course, is going to use the 6 that's on the closing papers because that's what they see in front of them. Now, let's go just a bit further and let's assume the new truck is going to be business use. If we use the $6,000 sales price, we're going to have $6,000 depreciation recapture on the 4797. If we use the $4,000 as a sales price, we got $4,000 recapture on 4797. But let's look at the asset that was purchased. And let's just assume the new asset started at $20,000 The dealer said, we'll take 6 off, so that means the taxpayer had to pay 14 for the new asset. If we use 6 as the trade-in value and 6 as a sale of the old, then the taxpayers treated as if they had paid 14 of cash plus 6,000 trade-in for the new vehicle. The new vehicle gives them a basis of 20. If we're going to say the sales price of the old is only the 4 that Blue Book said it was worth, then the taxpayers in the basis in the new truck is the 14 of cash they paid plus the 4,000 trade-in, which is only 18. So I either got a 6,000 on the 47.97 and a 20,000 basis on new, or I got a 4,000 on 47.97 and 18,000 basis on new. Either way, the net between the two, assuming the new is business, would be a 14,000 net difference, net deduction per se. So it doesn't really seem to matter, except if the 47.97 used the 6, they got 6,000 of income, no SE, and a 20,000 deduction on their Schedule C by writing off the new truck, whether it be makers or bonus or whatever. If we show 4,000 on the 47.97, we got an 18,000 deduction on Schedule C. The net income is the same, but in the first case, we had 20 on the Schedule C, and in the second case, we had 18 on the Schedule C, which means we got a $2,000 difference in the SE income, which is a 2,000 difference in the SE tax that's being saved. 2,000 SE income, 15%, you're talking, what is that, $300? Not a big deal with these dollar amounts, but it does save some SE tax. So in that case, I'd probably rather use the 6. But if if the new truck is strictly personal, I'd probably rather use the 4. If you find the exact answer, let me know.
But the ethics says that if you don't ask the questions, you're not doing your full job about how the dealer really sees it.
And the last part of that question also says, well, what if they sell it to a third party for 2,500? What's the gain and how much is taxable? Well, since it was sold to a third party for 2,500 and it was fully depreciated, we got 2,500 of income. Now that question does give us multiple choice, so 6, 4, or 2,500. Well, when you say it sells for 2,500, you mean the taxpayer sold it for 2,500. It'd be 2,500 income. If the dealer sold it for 2,500, that's their problem. Maybe that could be used to determine what was really worth a trade-in time, but the dealer's usually going to sell it to another dealer. They're going to drive it for a while and sell it when it's gone down in value. As it sits on the lot, it goes down in value just because it's older. So what the dealer sells it for is really not a factor unless you want to try to argue that was the true value at the time of trade-in. I'd much rather use the 4 or 6 if it was traded in. I would not be comfortable using the 2,500.
Now, just to muddy the water, if that truck were really worth $4,000, and that's what the dealer would give, or the Blue Book says, and you turn around and sell it to somebody else for 25, and that somebody else maybe is your relative, your best friend, or something like that, the IRS could come back and say that it was a part sale and a part gift. Because if it was worth $4,000 and you decided to do it for 2,500, that extra 15 could come back into it as a part gift.
Okay, I think that takes care of those questions that we have, Laura. I do see another one up on the screen. And that was Bill. He said he looked at Code Section 104 for this disability thing for the police officer. And he quotes that 104 says, this section also applies to compensation which is paid under a workers' comp act to the survivor or survivors of a deceased employee. So assuming that he has quoted that properly, which I assume is probably the case, then that police officer's pension, if it's not taxable because it's in lieu of workers' comp, would appear to carry over to the surviving spouse. So based on his citation there, and I'll probably go check it myself later just to make sure because that type of guy, but based on what Bill wrote, it looks like we'd have the same treatment going forward. Did we have other questions?
So what if you buy a new truck every other year and you use mileage on self-employment? Do you need to put the truck on the 4797? How do you treat this?
Okay, let me understand the question.
Okay, taxpayer used a truck for business, took the standard mileage rate, and now they traded in or sold it or whatever. Do we gotta do 4797?
Yes. The one of the main things that I want to make sure that the word trade-in is being used here. And remember, courtesy of TCJA, there is no trade-in of personal property that allows you to defer any gain. So what they're saying is when you traded in that vehicle, you sold that vehicle. You sell a vehicle that is a business use vehicle that has standard mileage rate, then you have to take into consideration as depreciation and lower your basis for sale purposes by the amount of depreciation that was taken, i.e. the mileage times the depreciation factor of the standard mileage rate for that particular year.
And I believe for 2020, the mileage rate is 27 cents a mile.
I think it's 27.
Maybe
It's the
26.
depreciation factor.
Yeah, the depreciation factor that they come out with every time they give us the mileage rates. I want to elaborate just a bit on that. This one says you use the mileage rate as your deduction. What if your employer is paying you back at the mileage rate? So you really have no income to pick up because it's at the government rate. You don't have a deduction of 2106 in the past or currently, of course, because it was reimbursed to the government rate. Does that have to go into 4797 when you trade it in? I'll let Mary answer that because I know she wants to.
I have an unpopular answer, and I would say that most people will never do this. But if it is a business use asset and you use it for business purposes, I believe you have sold a business use asset that depreciation was taken on, and it belongs on the 4797.
I agree. It's difficult for clients to understand, why do I got to report this on 4797 and pick up potential income when never took a deduction for it? And the answer is you use the asset for business and you disposed of it. That's why you got to show the sale of the business portion of that asset.
And you did not have income from the reimbursements, so it is another way of saying you got a deduction for it.
Agreed.
But in reality, how many times is it going to show up? That goes to the ethics part of your practice.
True. Other questions that you have? I don't see any others on the list at the moment.
I don't see any there on the list. We've gone through everything that we sent you, all those?
I believe we did.
Okay.
There was one that you resent this morning shortly after we started,
That you
after the
already wrote,
PPPs. It talked about the 5% owner of whether the 100,000 cap would apply to the husband and the wife
yeah.
in the S Corp, and we did answer that one. There's also on the PPP, that same email, it says owners, employees of less than 5% are not subject to owner-employee compensation rule. And when you read that on the SBA, it's saying that if they own less than 5%, the 100,000 cap is not an issue when it comes to the PPP loan amounts. But the 100,000 cap applies to everybody. So I'm not sure exactly what that's reading or if it's being read out of context involving something else. So I'm not sure exactly what that was about, but I believe that we have addressed the other part, that yes, 100 for the husband and 100 for the wife.
All right, so now, we have one that's just popped up here. Generally, when a self-employed sole proprietor who can afford to purchase a building for the exclusive use of his business, he's usually advised to establish a separate company for possibly both the business and property to rented to the business. What if the owner fails to do so? Is the rental agreement no longer an option? It's in the chat.
Yeah, I'm,
Big
we're
question.
just talking about this. As far as this is concerned, if you're a sole proprietor and you own a business and you set up another business that is, for instance, a Schedule E or an LLC disregarded entity, you cannot rent from yourself. So the entity that was set up would have to be some other kind of entity, which is, for lack of a better term, a tax-paying entity on its own. For instance, you could set it up in a corporation, which usually we don't talk about putting real estate in a corporation,
But you could.
but you could. And then in that way, if you were paying the corporation, you would be able to deduct the rent and save SE tax possibly there. Years ago, there was a court case about a husband and wife that owned a building. And if the husband were renting the building that they own jointly, the best case scenario would have been half a rental deduction representing the spouse who was not part of the business, and depreciation of the other half because the person who had the business owned the business. But that's the best side. Unless you're willing to set up another tax-paying entity to contribute that building to, I don't see the advantage of putting it in a separate entity. Oftentimes, having a building in a separate entity is a liability concern, but in my mind, having a good liability umbrella policy would offset having it in another building because of another entity because of liability. Do you have anything else you want?
I want to add just a little bit more that there may be a time you can have the C rent to the E, but not for your ownership. For example, Mary and I own this building or own a building, and I have a Schedule C. I could rent from Mary her half of this building.
I already said
Oh,
that.
you said that?
Yes,
I'm sorry. Okay, nothing new.
thank you for listening.
I was looking at one of the other questions,
I
trying to
know
find an
you
answer
were.
down there. So,
I know
okay.
you were.
All right, did you look at that final one from, I wrote it, but it actually came from somebody else, but can you confirm if COLA increases to that disability pension are taxable?
And the answer I have is, I don't know. So I have to give the answer of, I don't know if the COLA differences, cost of living adjustment differences are taxable or not. I'd have to go probably into the regs or the court cases. I was looking in the code while Mary was talking on the last question. She was ignoring me nicely, but I did not find it in the code. So I don't have an answer at this time. Do you have an answer?
No.
No. So no good on that one.
So we have now answered all the questions that people have put out there so far. Although they're still coming in, does it make sense to keep the PPP as a loan if Congress doesn't allow expenses to be deductible and not apply for forgiveness?
Oh yeah, I saw that one earlier. Thanks for putting that back up there again, Cheryl. Here's my answer. If you keep it as a loan, you got to pay it back. That means you're losing money. If you get the forgiveness, you have, if you keep it as a loan, you get to deduct the expenses, but you got to pay the money back. If you get it forgiven, you don't get to deduct the expenses, but you get to keep all the money. So you're really asking what's the tax difference, whether I pay it back and write off the expenses versus have it forgiven and don't get the expenses. Tax-wise, you'd be better writing off the expenses, but then you got to pay the loan back. So if I'm looking at paying a loan back, let's say it's 100 grand, nice simple number, I'm out 100 grand, but I get the write-off, so maybe I'll save 37% if I'm in the top bracket, maybe even 50% with SE tax, maybe even 60% with SC, income fed and income state. I'm still out 40 grand. So why would I want to pay back a loan just to save tax dollars? And I got clients at my desk that often say, well, I want to pay interest on my house because I get to write it off. And I tell them, well, you pay $5,000 of interest. I'll make it easy. It's saving you 2,000. You give me a check for 5, I'll give you a check for 2, and we'll call it even. And of course they laugh at me and I say, it's exactly what you should do. That's a ridiculous thing to look at, because in the pocket, is it better to pay the loan back as a loan, or is it better to give up the deductions? I would always rather pay the loan back and not give up the deductions. No. I'd always rather give up the deductions to avoid paying the loan back, because I'm going to come out ahead financially. So I like to look at their pocket, not just at their tax return.
If the loan is forgiven, it's free money. The fact that it costs you a little to get the free money is just saying you didn't get as much free money, but you still are getting free money.
Okay, so I've just forwarded another question that was sent to me privately. For a self-employed taxpayer who has advanced premium tax credit and additional health insurance premiums, what amount is to be used for the SE health insurance deduction?
So they got the advanced premium tax credit and then had to pay additional insurance besides that?
Well, I think what they're saying perhaps is that we all pay a certain amount, and then there's that credit in column 3 of the 1095A.
Yep.
And I think that's what they're saying. Which number are they using? Now, I know our software calculates it, but you have to put it in a very specific way in order, because it's a circular calculation. I believe that's what they're asking. If that's not what you're asking, write to me. And
Okay, and your answer is exactly the correct one. The IRS came out with a worksheet, when this thing first started, which would have been back about 2000, was it 10 that Obamacare came into play?
Yes, but it was a couple of.
2010, so it's probably within a year or so after that they came out with a worksheet which does a circular example or circular calculation to come up with the amount that we get to deduct. Now, when they came out with that, the calculation was one of 2 ways. One is you enter all the health insurance the client actually paid after the credit, take your deduction for self-employed health insurance deduction, then do your calculation of the credit to see if there's a repayment or additional amount. And then if there's an additional credit, you go back and you determine how much your client really paid after that credit, and you redo the SE health insurance deduction. Then you redo your repayment of the credit, and you keep going back and forth until you have no additional credit or repayment and no additional SE checks, SE health insurance deduction. You keep doing that forever until you have no difference. If you don't want to do all that work, you do it twice. You do the SE health insurance, you do the calculation of the repayment or additional premium tax credit, then the SE health insurance, then the premium tax credit, and you stop. So either do it forever until neither number changes, or do it twice and quit. Your software gets to, your software will do, I guess, whichever one your programmer felt was the right way to do it. So your programmer is probably making the decision for you, which is kind of fun to have a computer programmer doing tax calculations.
Computer program who's not a tax specialist.
Computer programmer is not a tax specialist. Let's see. I'd like to see a show of hands. How many people out here have a programming degree? Let's see the hands up. Well, on my, there's one down there. And maybe that was just somebody standing up. I only see one hand up here, and that's mine. I got a programming degree. It was in Fortran, Assembler, Basic, Pascal, and my favorite, COBOL, which is why we had Y2K, because COBOL was big business use. I'm a programmer, 40 years old now in my programming degree, but I'm a tax professional as well. You don't find people that have both of them. Usually you're either tax or you're a programmer. So the programmers are trying to do the best job they can, relying on the IRS pubs and rules and relying on tax professionals to help them, but they're still the one that's making the decision on which route to go here. So either do it twice or keep doing it forever until you get an answer that neither number changes. And that worksheet's been out for at least 8 years now.
So every time I talk, somebody pops something else in there, but so far it's stopped. So what I'm going to do now is allow you to mute yourself in case you would like to say something. Please don't mute yourself unless you have a question, because we'll get too much back noise. And we're going to see how this goes, okay? If it doesn't work, I'm going to mute you all again. So hold on.
So you're gonna unmute everybody. All right.
No, what I've done is I think you can unmute yourself if you'd like to ask a question.
There we go.
So hopefully that works. So if anyone has a question or a comment, and while we wait for that, I'm putting in the chat right now the email, I hope. Nope, that's not it. We'd like to hear your feedback on today's, what we did today. We've never done this before, and we're learning, and so we're kind of hoping. So you can either reply to any of those invites you got or send an, I just put the Connecticut chapter email in the chat box. We would like to know what your feedback is, if you liked it, what you'd like to see differently. And we do have this being recorded, and I'm going to try and see if I can edit it down and get rid of the breaks and maybe break it up into sections if I can. And apparently an easy way to unmute yourself is to press down on the space bar. That's showing up for my lovely husband in there. So how are we doing, everybody? Anyone have questions? Board members, anyone?
Somebody unmute yourself and say go past go or something, just so I know it works.
Go Pats, go.
Hey, Robert worked over there. Good.
Yeah, but
So
he's
it
a
does work.
host. He's a host, so I don't know if that works. If you're not a host, Anita, unmute yourself and say something for me, will you? Try your space bar. All right,
Right, I tried the space bar.
Hey,
okay,
now I can hear you, Anita.
it works. Thank you, Anita. Thank you. So, I guess,
Rosemary looked like she unmuted up there.
I just figured it out. We watched the Packers last night. Good game.
Hey, good. I fell asleep.
Charles, are you writing to me? I see Charles is writing to me, but I'm not getting any messages through for you. So let me know. So please, if you could all just send your feedback to that email, and please show up for our annual meeting on December 16th. We're going to have a New York State update because a lot of us do both New York and Connecticut returns. We're going to have a Connecticut State update. And we are hoping to have something to do with practice management or security. We're working on that, okay? Remember, the annual meeting portion only takes about 10 minutes, 15 minutes. It's really, really quick. But we have a legal requirement and a state requirement to run this meeting. So please turn up for that. And may I also take this time to thank David and Mary so much for figuring this out with us. You guys rock as always. You are wonderful, and I'm seeing lots in the chat here. You'll have to have a read through because I think.
Excuse me.
Yeah.
Hi, I just have a question. I wrote down that you said on December 16th, we're going to have our Connecticut update. But earlier you said on December 14th, Catherine Keene's going to be speaking.
Which one? Hold on. It's December 14th. I'm so sorry. You are so right. December 14th, everybody. I will send out a save the date shortly with that. Okay.
Okay.
It's
So
all
it's
going to be in
December
one go.
14th.
Yep. All in one
Okay.
go. Thank you.
Oh, you're welcome.
So yes, so if I can reiterate, David and Mary, thank you so much. We really loved having you and wish we could have had our 2-day seminar in person, maybe soon, someday soon.
Thank
We
you for
hope
inviting
so.
us.
And with that, I guess we'll adjourn. Is that it? We'll close. Goodbye.
Great session.
Yes,
Thank you,
Sheila.
Mr. and Mrs. Mellem. Thank you very much.
Thank you
Thank
so much. You
you.
guys were great. Thank you.
Bye.
Bye-bye for now.
Thank you.